Okay, I hope everyone is here. Is ready to. All right, let's start. Now, basically, tax planning would be something that you will cover tomorrow. Okay, under your afternoon session, which is zakat and tax planning. So I would just run through an introduction on tax and why is it relevant to module one, as well as why is it relevant to financial planning. So as you have seen, taxation is one of the components on personal financial planning because tax will involve us, whether you like it or not. Tax is something that is certain. I hope you're able to hear me better now. I have changed the mic as well as my headphone. Yeah, so hopefully it's better now. Okay, now tax is the important component as we have talked about just now at the module. Tax are fundamental issues when you plan for your client's finances. Our objective as planner is merely to either minimize your client's personal tax liabilities or as far as possible, anything that can be deferred, we defer it. Okay, that's about it. We do not teach the client to avoid or run away from tax altogether, right? So it is just a matter of minimizing, using the legal and available ways to either get more relief or perhaps to do certain investment that would be tax savings, right? That is our objective. Our main objective is actually just to minimize the personal tax liabilities. If you have a client who have a personal business or is corporate, so you would need somebody who is actually very apt in corporate tax. So that would be something that you need to think about when you advise your clients on taxation or business taxations. Okay, so you would either have a direct tax, which is the tax on income, on personal and corporate income tax. So the key word here is it is income taxation, because the law that governs income tax is called Income Tax Act 1967. Okay, so this is where in Malaysia we only tax on income. If you have a capital gain because you have invested in a share and your share has appreciated in value and you have more capital now, that capital gain is not taxed. The only capital that is taxed is your real property gains tax. So we have to remember that. So the taxation is actually on income of a person or an income due to profit for a corporate. All right. Indirect taxes will be taxes on goods, whether it's GST or SST. We do not know whether GST will be making a comeback, but let's see how it goes. All right, Income Tax Act. The act that governs income tax is Income Tax 1967. This is the basis of tax computation. Income is the basis of tax computation. The scope of charge tells us what is to be taxed. Income tax shall be charged for each year of assessment upon the income. The keyword is income from any person accruing in or derived from Malaysia. That means you earn the income here, you earn the money here. Okay, the receipt in Malaysia from outside Malaysia, that one, if you have earned something in outside of Malaysia, you would have paid the tax in that country. When you bring it back to Malaysia, it is no longer taxed. Okay, that is under the, there was an amendment to that. All right. The year of assessment would be 1st of January to 31st of December. So if you have done your own tax submission by the easy hustle, you would know what I'm talking about. Okay, so your actually all of us more or less would be quite apt to be able to advise your clients on personal tax because most of us would have done. It's just the nitty-gritty and some of the taxation details that we need to understand the concept when we advise our clients. Okay, so income, basically, it does not specifically stated in Income Tax Act, but we always look at the case laws that is in Malaysia and is in Commonwealth, and also what is the judicial precedent cases that they have ruled, what is income and what is not. If you're talking about Durian Runtuh, let's say you have suddenly a very big lottery strike, is that an income or not an income? All right, maybe it's not an income, but if you consistently, but if you consistently, but if you consistently earn a lottery, I mean, you always strike the lottery ticket, then it may be considered as an income because you consistently strike the lottery. Right? So the definition of income is very subjective according to the law. Okay, so what we want to do is generally it should be a receipt or a gain, which is income in nature. That means it's regular and it is always quite consistent, that we can consider as definitely an income. But if it is capital in nature, let's say you dispose your share, for example, you earn a profit on your share, it's capital gain, then it's no longer considered as a income. But the only capital gain that you will tax is RPGT, which is real property gains tax. Now, the person that the income tax is referring to that is being taxed is either an individual, which is us, any person, or a corporate. So that means if you are a company, even though you own the company, which is Sendirian Berhad, it is taxed, the Sendirian Berhad is taxed, or a trust. The trust body is actually then will be taxed as well. So corporation as an individual body and as well as your interest gain. Yeah, there's a certain exemption on interest gain, 100,000 above. But if you are a foreigner, you definitely no interest exemption. There is certain exemption on interest gain. Okay. Now, so a company and a body of persons, which is the corporate, which is not a partnership. The partnership, they will be taxed accordingly to themselves. That means a sole proprietorship will be taxed on the sole proprietor. The partnership will be taxed on the partner. Okay, each partner will be responsible for their own income. So it's a corporation or a person that will be taxed under the Income Tax Act. Now, if you are accruing in and derived from, meaning the source of the income must be in Malaysia in order for Income Tax Act Malaysia to be effective on that particular income. Okay, now the sources of income is what is defined in the Act. The source of income is either is a gain or profit from a business. It will be considered as a income under Section 4A. Section 4B will be gains and profits from an employment. So most of us will be under the gains or profit from employment if we are under an employment, or if I'm a sole proprietor, then basically you 4A. Okay, if you receive dividends, interest, and any trade discount, it will be considered as income under 4C. Okay, if you receive rental income from your investment property or royalties from your songs or your premiums or anything, it will be under 4D. Okay, for subsections D, or if it's 4E, it will be pensions, annuities, and other periodical payments not falling under all this else. Okay, and if it is not A, not B, not C, not D, not E, it doesn't mean that you escape from income tax. There has a category called 4F. Any gains or profits that is not falling under any of the above paragraph will be under 4F. So the classification of income will also determine your tax treatment. So if you are under Section 4, capital A, that means 4 subsection A, it is special classes of income. What do we mean? If you have employed somebody from outside to pay to render services for your installation, any plant or machinery or technical assistance, or any administration or scientific project or any rent or anything under movable property, this would be classified under withholding tax. That means if you are a non-resident, meaning let's say you bought a machinery from Japan, okay, you need some technical assistance from a Japanese engineer, but you do not employ him. You write into the Japanese company and they send an engineer over. So the payment that you pay to that Japanese engineer would be subjected to withholding tax. That means you are actually paying income tax on the on the technical assistance behalf, which is already you deduct. Let's say if the income tax withholding tax is 10%, you're supposed to pay him 100,000. You already withhold at 10%, which is 10,000 to be paid to income tax on his behalf. So he'll be carrying the 90,000 back to his home country. So this is what we call special classes of income. So resident status would be determining whether you pay Malaysian income tax or if you are a resident of another country, pay the other person. So resident status does not and is not equal to citizenship. You can be a Malaysian, can be a non-resident Malaysian if you are not in Malaysia for a specific point of time, specific period of time you're not in Malaysia, you can be a citizen but not a tax non-resident. You can also be an expat, or maybe you are a foreigner, not a Malaysian citizen, not even a PR, but you worked here in Malaysia for a specific number of days that you are here in Malaysia, then you are considered as a tax resident even though you are not a citizen. All right, so that is the difference between tax residency and citizenship. Okay, so you must be very careful on these two concepts. So how do we determine that? But what is so special about being a resident? What is so special about having a tax resident in Malaysia? Most importantly is if you know when you do your calculation for income tax, that you can deduct certain personal relief, right? Personal relief like your personal relief of 9,000, then you have insurance deduction of 6,000, then you have all your medical insurances of 3,000, and then your PRS of 3,000. So all these things basically are the relief that you can deduct. But if you are a non-resident tax payer, that means you are not a Malaysian tax payer, you cannot deduct all this relief from your income. Meaning if you earn 10,000, all the 10,000 will be taxed against. Whereas if you are a tax resident, you get to deduct all your 9,000, all your relief. So that is point number one. Point number two, you get to enjoy the tax schedule. That means if you earn a certain amount of income, your income tax is only at 10%. If you earn up to a certain amount of income, you will earn only be up to 15%. And if you are above 1 million, then you are taxed at 28%. So these are what we call the scheduler tax. But if you are a non-tax resident, that means you're not a Malaysian tax resident, you will pay flat rate of 26 or 28%, depending on the highest tax bracket. You don't get to enjoy the scheduler tax bracket. And of course, definitely you don't have the tax rebate. If you know that in Malaysia, if your chargeable income is below 35,000, you will immediately get a 400 ringgit tax rebate, so that you don't have to pay tax at the end of the day. But this tax rebate is not applicable to a non-tax resident. So that is very important why we need to determine whether a person is a tax resident or not a tax resident. And afterwards, we will see how we determine that. Okay, for a company, as long as your income is derived from Malaysia, they are already taxed on the corporate tax rate. Now, how do we determine whether that company is resident or non-resident is also very important, because again, it's the tax rate. Okay, now if a company is resident here in Malaysia, then definitely in Malaysian income tax will apply. Now, one thing that is very important in a company is if this company is a banking, insurance, shipping, or air transport company, even though their income is not from Malaysia, let's say for AirAsia, for example, they have AirAsia India, AirAsia Indonesia, and all those income that comes into their corporate group, because the AirAsia is a tax resident, meaning even all their income from the worldwide subsidiary have to be reported in Malaysia, and they are subjected to Malaysian income tax. So companies like MISC for shipping, where you have an insurance which is headquarters here in Malaysia, but they have other businesses all around the world, all the other income that comes in, even though it is not derived in Malaysia, but received in Malaysia under this law, then basically you are a Malaysian tax resident company. You have to pay under the Malaysian tax. Okay. Now, resident tax, how do we know whether this person or this particular individual person is a resident tax? First of all, if that person is here in Malaysia for more than or equals to 182 days, physically present in Malaysia, you will be under Section 7, S7, Paragraph 1, Subpara A, which is more than or equals to 182 days physically present in Malaysia, then for that whole year, you are a tax resident. This is taken by the graph. Okay, so this is the graph that you are here more than 182 days or equals to 182 days. So you are whole resident for this whole year. Let's say if you are not here for more than 100, you are less than 182 days for the past year. Okay, this will be under Section 7, Paragraph 1, Subparagraph B. Meaning you are not here for more than 180 days for last year, but this year you are here for more than or equals to 182 days, and this period is actually linked. See, it's linked together, right? So both this year and last year, you are also a tax resident. The only permitted temporary absence, that means if the only break that is allowed in any of this continuous period is, first of all, it must be connected with your service in Malaysia, and because you are attending certain conference, certain seminars, certain studies in out of Malaysia, but it is actually related to your service in Malaysia, then you are still considered as a continuous period of 182 days. Okay? Or if it is owing to ill health, owing to yourself or a member of your immediate family. When you say immediate family, it's spouse, if you're married, children, if you have children, spouse and children, or if you're single, then it's parents only. So those are immediate family members. Okay, so that is the permitted absence that you can be not in Malaysia. There's a break in the continuous time period, but you still be considered as the continuous 182 days. Or if you go back for holiday, let's say if you go back for Christmas holidays for 1 week, doesn't exceed 14 days for social visit, then it is also the allowed break in the continuous 182 days for these 2 years. This is how you test the residency. But let's say both of these condition you didn't meet. There is another test. Now, this test is Section 1C. Section 1C tells us that if you are not here for more than 182 days, but you are here for more than or equals to 90 days, then we have to see of the many years, how many years you are here for your residency test. Okay, so what happens is if this year you are here for more than or less than more than or equals to 90 days, then we have to look back the past 3 years. If for the past 4 years you are 3 years a resident out of the past 4 years, then this year you are also a resident, even though you did not meet the more than or equals to 182 days, but you have met the more than or equals 90 days. So we have to look back for the past 4 years. 3 out of 4, you are then considered as a resident this year. Now, if 3 out of 4 of the immediate preceding years, you are in Malaysia for more than or equals to 90 days, this year, even though you have not met the 182 days, but you have met the more than or equals to 90 days in this year, the past 3 years you have more than or equals to 90 days, also you will be a resident this year. Okay? Now, Section 7(1)(d) is a special case. If you are a resident for the past 3 years and the subsequent year you are also a resident, you can be absent for the whole year this year, but still considered as a tax resident. This is a special case. So remember this. That means you are, the next year you are a tax resident fully, and the past 3 years you also have been a tax resident for the past 3 years. This year, even though the whole year you were not here, but you can still be a tax resident. Again, what is the importance of tax residence? First of all, to have your tax relief. Secondly, to have your scheduler tax rate depending on your income. And thirdly, you can get your interest exemption. Okay, so these are some of the things. For if you are non-tax resident, you do not get to get all those relief, no deduction, you will straight away tax on your gross income. Secondly, there's no scheduler rate for you. They will just tax you straight away 26 or 20%, depending what is the highest personal income tax rate. And thirdly, any interest that you earn in Malaysia, there is no exemption. So that is something that why the importance of having tax residency test. Now, Section 8 will apply for a company or a body or person means that trust, okay, or an estate or whatever it is. It will be taxed in Malaysia if your management and control of business is exercised here in Malaysia. What do we mean by that? That means where you have your board meeting. Even though your company is incorporated in Hong Kong, for example, or in Singapore, it doesn't matter. As long as your board of directors have your meetings in Malaysia, your meeting or your minutes of the board of directors is written here or held in Malaysia, then it will be considered as management and control of businesses exercised in Malaysia, and therefore you will be considered as a Malaysian tax resident company. Okay, so that is how you test a company's tax residency. So this is how you look at your chargeable income. First of all, we look at your Section 4 and 4A, right, which is your source of income. So the gross of income must be accrued or derived from Malaysia. That will be called your gross income. And then you deduct all your expenditure in the production of those income. That means if you are in business, for example, all your business costs, you can deduct it, but you have to add back all the disallowed costs. So that will be your adjusted income. After your adjusted income, if you deduct your CA, your capital and balancing allowances, this is especially true for those who own assets bought by the business or by the sole proprietor. Then after that, that will be called your statutory income, which you have to include back your balancing charges because capital is allowed to you, so you have to add back balancing charges. All these technical things you can look at your textbook, and also tomorrow when you have your tax, probably the tax lecturer will actually explain further to you. Then after that, from a statutory income, you derive all your forward business loss. So it's good to be in business because you get to carry your business loss from last year into this year and deduct out from your income from this year. Okay, let's say if I'm a sole proprietor, I have a few business, I can actually bring forward my other business loss into my current business income and deduct it out. Then it will become my aggregate income. So from aggregate income, when you deduct out all your allowed costs for the current year, which would be including your adjusted loss of your business, as well as all other approved donation, and it must be approved donation. You cannot say that, oh, I donate to these people and take it out from your income tax. It must be an approved donation regulated body that is licensed by income tax. Income tax will give you an income tax deduction number for donations. Right? So, for example, National Kidney Foundation or probably Majlis Cancer Negara, all these have the income tax exemption number. That is the approved donation that we're talking about. So that after deducting the donations, you will call your total income. And you use your total income to deduct out all your personal relief. All your personal relief, like your insurances, your EF, your medical insurance, your personal relief, your lifestyle relief, and all that. Finally, the amount will be called chargeable income. And that is where you calculate how many percent of your chargeable income you need to pay income tax. That is how they derive that. So if you notice, this is also the way that they let you fill in your assessment form, right? Under your B or BE form. This is how it is. And they will charge on the chargeable income. So for your additional reading, please take a look at all your the text section. Of course, some of it already is outdated because I think the textbook couldn't catch up with the amount of changes that taxation happens. So good to know. Budget is coming. Please take a look at the budget because it will affect everybody, it will impact everybody. And it's a good practice for financial practitioners and financial planners to take a look at what is the current tax rate, what are the current tax incentives, how do we fully utilize the relief that is given. Okay, so that will be your additional reading. This kind of table easily available on Google. You just Google Malaysian tax rate 2020 or 2019, that will be the latest. So this is the scheduler tax rate that I'm talking about, only for resident individuals. So if you earn, this is how much you will pay. Basically, types of income, this is also the rates of tax. If you notice, if you are a concert, someone like Jackie Cheong or probably Justin Bieber, if they ever do a concert here, they will be taxed at 15% because you're a public entertainer's professional income. And interest is taxed. Why is it taxed? Especially for non-resident individuals at 15%, the interest income. Royalty, if you ever earn, is also taxed. Special classes of income, this is already stated, the section 4A, where you ask somebody from overseas to come in to maintain your plant or do some scientific, and then you pay them the money. They are actually supposed to impose a 10% withholding tax. You're supposed to pay them 100,000, you only pay them 90, the other 10,000 pays to the government on their behalf so that they don't run away and then we couldn't locate them. Now, dividend is exempted if you're a single tier, but if you have a lot of dividend, basically it will be considered as an income. So yeah, it will be taxed accordingly to your tax rate. Now, business employment income, if you are a non-resident, you would be taxed at 26% with effect 2015. Okay, so this is the highest corporate rate, the highest personal tax rate that you will be taxed. Income that is not covered by here but is earned by a non-resident will be taxed flat at 10%. So this is why it is important to find out whether you are a resident or non-resident. Okay, so these are the personal relief that will be, of course, this is already 2015, so 2020 will include the lifestyle tax and lifestyle relief and whatever else. Yeah, so these are some of the things. And if I'm not mistaken, I think your RFP may be considered as your this $5,000. I don't know. You have to check with MFPC as well as also check with the income tax section. Okay, tax rebate, that is what we're talking about, only for resident individuals. Non-resident will not have this 400 rebate. Meaning, if your chargeable income does not exceed 35,000, the government will give you a 400 rebate. But if let's say you have calculated and your payable tax is 300, but you get a rebate of 400, you don't get the extra 100. The concept here is whichever is lower is your pay. Okay. Now for Muslim clients, your zakat, your fitrah, and any Islamic religious due is exactly the amount that you can take out from tax. So meaning whatever amount that you paid for zakat will be considered as a payment to the income tax department in that sense. Okay, so basically tomorrow, zakat and tax planning, very important. Please pay attention to whatever that is discussed tomorrow. Yeah. Okay, so that is just an introduction. So I just need to let you know under the tax section, they will only test you a few things on our paper one, that means module one. First of all, they will need to know whether you know what is income, what will be taxed, what will not be taxed. Secondly, what is the importance of being a tax resident or non-tax resident? Thirdly, they will need to know how you determine whether that person is a tax resident or non-tax resident. And fourth, whether you are able to advise your client to use the relief that is given to him or her. Okay? Or maybe an additional question will be, is it better to have a joint assessment or a separate assessment for husband and wife? Very interesting concept. So maybe tomorrow you will get to discuss that. Okay, now that is all I need to share on tax because it's a very small little topic in the whole financial planning, and you would have a particular topic on tax planning. Okay, any taxing money in FD interest gain is taxable? Yes, if it exceeds 100,000. There's a schedule in Income Tax Act. If I'm not mistaken, I can't remember the Schedule 8 or whatever it is. There are a list of exempted income. Not all pensions are exempted from tax as well. Some are not. So you have to take a look at the schedule, what is exempted and what's not exempted. Interest income, if your FD or is more than 100,000 and your interest income is derived from any amount that's more than 100, I think actually supposedly to be reported as income. Okay, so that one you have to check with the tax actuary. I'm not too familiar with that, but definitely if you are non-resident, there is no exemption at all. Any interest that you earn in Malaysia, you will get taxed. Okay, I hope that has answered your question. Back to the question of Dr. Muhammad on your restricted dealing. I have checked with the handbook of licensing on CMSL. I think that statement refers to any item that you can only deal with. Okay, so if you are given a specific license on dealing that you can do all securities, then it's all securities. But there is conditional dealings like you cannot deal with derivative unless and except you have a certain approval from SC or something like that. So your firm, the license doesn't mean that you have a blanket dealing license. You can deal in anything, you can deal in any share, you can deal in any products. No, it has to depend on the person that is operating. It has to depend on the license that is granted to the CMSL. So the restricted dealing here, I think restricted may not be a good word, but what I would say is actually there's limited dealing. Okay, it all depends on what is the available granted license to you. So I hope that will answer your question. Okay, about restricted dealing. Okay, let's move on. All right, I will skim through investment planning because investment planning is what I will deal with you on what do you call that, on Wednesday. Okay, but just a quick run through of what is investment planning. Now, I want you to understand the investment planning basic at the moment. You take note of these two things. One is the double I and one is your double R. What is double and double R? What do you think this is? This is not mooncake. This is your roti canai back in 2005. It was only at 50 cents. And I'm sure right now it will be selling at about 150, 180, depending on where and which market you go to. Okay, so if you notice, first of all, the price has increased. Secondly, the size has decreased. So what do you call this? Inflation. That's the concept, a layman's term on what is actually inflation. Prices went up, sizes went down. Okay. Now, if you notice these jars, every month it increases in value. Okay. So this is what we call interest. And only compounded interest gives you such kind of return. Right. So this is what we mean. So the double I here is inflation and interest. So this is interest adds on to your money, but
Sorry,
inflation.
Mr. Teh.
Yes.
We don't see the slides.
Oh,
Thanks,
yeah,
thanks,
I've
thank
told
you.
you.
Sorry, yeah. Sorry for
Yeah,
this.
sure. No problem, no problem. Just now, the other subject was okay. Text, you saw the slides.
Yes.
Okay, all right. I think so. I have to share with you. Yeah, thank you. Because I couldn't see what you can see. I only know what okay, now better. Okay, you can see now. Okay, right. So this is your double I. This is what I meant just now. The price has increased, but the size has decreased. So this is called inflation. Money earning money, interest on interest, that is compounding, that is your interest. So we, as a planner, we are very particularly focused on inflation and interest. We need to let the client know that inflation takes away your money, but interest adds on to it. So the trick here is to find something that will give you interest that is more than inflation so that you get a net growth, right? So that's the double R. Your double I, sorry, your double R is the concept of risk and return. This is the basic fundamental law of investment. If you want high return, you have to have high risk. If you want low return, then you can go for low risk. If there's no risk, then that means there's no return. High risk, high return, low risk, low return, no risk, no return. That is the concept. Okay. So we also need to know what is investments, what's the difference between investment and savings, and what's the difference of time value. I mean, what is the concept of time value of money, which we have run through just now. Okay, so this is all about investment planning in one slide, in one concept. Okay. Now, what is savings and investment? What's the difference between savings and investment? Which do you think is the savings and which do you think is investment? So this is investment and this is your savings. Does the tortoise always win? Or does the hare always win? Not necessary. That means basically in a financial plan, you must have a good balance between savings and investment because savings gives you the stability, especially in this kind of market where it is uncertain. Sometimes it is at a loss, so you need the basic savings to be the solid emergency fund or something to fall back in case your investment goes haywire. But you cannot also have everything in savings because if you have everything in your savings, then your growth, remember the inflation and investment concept, you will always lose money because whatever that you put into your FD or whatever cash account is not earning as much as your inflation. So you still need to invest. Okay, so this will be very prevalent when we talk about investment planning and when you study about retirement planning. The very important concept of investment, it would definitely be just better than just putting money in something that will only earn you 2%, 3%, which is lower than inflation. Okay, so you will see that in retirement planning as well. So what is investment planning? So it's to allocate your investment asset. This one we will go in detail on Wednesday. But most importantly for us as a financial planner is to match your investment product to your client's risk profile. You need to know what is your client's risk profile, because always remember the basic of investment: risk versus return. If your client is somebody who does not like risk, then it is very difficult to give him to introduce something that gives him a high return, knowing that when you are having a high return, obviously you may face a high risk. Okay, so that is the concept. So what will you do with your money if you have 10,000 ringgit? Do you really keep it at home, or do you store it in a bank, or are you going to buy any shares, right? So, or are you going to buy bonds? So every thing that you decide on, it has its pros and cons. So there's no such thing as what is a good investment at the moment? What is the best investment at the moment? The key word that I would give you is it depends. It depends on what? It depends on a lot of things. It depends on your risk profile. It depends on what is your objective. It depends on what is your uh, uh, time horizon. How long can you invest? All right. So if you run through all these, then you realize that investment, there's no such thing as uh, uh, what they call a very best investment at the current moment. What will be the best investment? What will be the best investment? That is not for us to decide. We have to decide based on the objective, based on the time horizon, and also based on the risk profile. As long as it meets our objective, as long as we can lower down the risk, that will be something good. Okay. So basically, your investment reward will be very much related to your investment objective. Are you going to protect your wealth? For example, let's say, well, you can put it in an FD. Or are you going to just be earning income, which is a guaranteed regular income? Well, you could be on bonds or some good stocks that gives you fixed dividends or quite regular dividends. So that it could be a concept. Or are you going to go into growth stocks, which gives you high price return, but basically you have a very high risk of even losing everything. So that is something that you need to be very careful about. All right. So your investment risk, basically, these are the investment risks that you have. You may have credit risk. Credit risk meaning people borrow money from you, cannot return back, especially bonds because are corporate debts to you, or mortgages. You have that. Liquidity, some of the problem with property, you bought it but you cannot sell it, it's very difficult to sell, times are no good. Well, that could be problem with liquidity, or is it the market risk? The market fluctuate when you want to sell your equity, suddenly the share price drop and you wanted to have money from it. So that's difficult. That is the market risk that you have to face. Or are you putting everything into one basket? All my money is in the stock market. Well, you need a little bit of diversification in that sense. Or is it going to be inflation risk where you put it into fixed income and you keep dropping like currently, right? Currently, you put in a fixed income, then it's quite difficult because we're talking about below 2 now. Will we go into zero range, or could we go into negative range? It is possible. Developed countries like even Japan has a negative interest rate regime, which is like you put money in the bank, also you need to pay the bank money. Now, what does that mean to us? That means they are trying to push people, instead of from savings, push your money into investing, right? So that is the concept of why we have a negative interest regime. Now, also, maybe if you are buying a local currency asset, is it that if our currency drop, so will the asset value, right? Because you compare with other things. So there are a lot of other things, political risk, regulation risk. Suddenly you find that, oh, they outlaw Bitcoin, and then the Bitcoin will suddenly be worthless. So these are some of the things that we have to be very careful. So what is inflation? Now, you know that we have talked about this in the economic situation. We must take inflation into consideration. Why? Again, because the value of your money will go down. You will lose purchasing power. That is why it is very important. What is inflation? What is it caused by? Demand pull inflation. I think at the current moment, we are actually slightly going to go into this, because what I mean by that is, as long as you have more money in the system, there are more liquidity in the system, but your goods are not being produced as to meet the demand. So we have too much money chasing for too few goods. Let's say last time we used to have 100 ringgit, and one item is 100 ringgit, so 100 to 100 fair. But now we suddenly have 110 ringgit because we increase the liquidity, it becomes 110 ringgit. the break will no longer be just 100. It will rise in tandem to become 110, so that the 110 ringgit we have right now, supposed to be a value of 100, is buying the same item at 110. That is what we call demand pull inflation. All right. So what can we do? We either increase your interest rate so that people will then, oh, interest rate has increased, so we save money again. Okay. But if you keep pushing your interest rate downwards, that is something, because now there's a flush of money into the system because people don't want to save anymore. No point putting in FD. So I might as well take it up to consume. And once that happens, it may cost. So these are some of the things, and these are very economy and very macroeconomy kind of concept. So let's put it as we just understand what are the causes of inflation. Now, basically, there is also a cost push inflation, which is when your company cost goes up. That was what was happening before this. That was when all the company need to employ more workers, so their cost becomes, and then all the raw material prices has increased, so they need to increase your price of product. And when you push it into the market, and everybody suddenly find that why is items becoming more expensive? Because their cost has actually went up. So this one also basically is another cause of inflation. So either you have too much money into the system, liquidity, or you have increased price across board because the cost price, because of the raw material, because of your human resources and all that have cost up. So these are the two reasons why there is inflation. So how do we grow our money? Basically, it is your tips for your client. You reinvest the interest to earn interest on interest. That is a compounding concept. Or you invest in non-taxable incomes, like what? Your EPF contribution. Increase your EPF contribution because EPF gains, EPF profits, EPF dividend is exempted from your income tax. Even if one day you were to withdraw all that you have gained from your EPF when you retire, it is non-taxable. EPF contribution is tax exempted. Okay, bank interest up to a certain amount. Oh yeah, that is Schedule 6. Now I remember. Look at Schedule 6 of your Income Tax Act. It will write down what are the exemptions that is from income tax. Okay, whether it's bond, dividend, under dividends, all these. If 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 it's listed in the exemption, then it will be tax free. So do look at Schedule 6. Yeah. Okay, so investment strategy, success investing is definitely about common sense, which is not so common nowadays. All right, buying and selling always, this one everybody knows, basically is to buy low and sell high, right? But the concept is very good, but do we know when it's low and when it's high? Is it high now or low now? So these are some of the things that we need to figure it out. And most of the time, you have a lot of analysts that tells you this, tells you that, but are they accurate? How good is their forecast or technical prediction? Right. So this is something that you need to understand. So if you want to go into the market, active trading, do you have the knowledge? Do you have the courage? Because the risk of daily intraday fluctuation of prices could be very high, right? So you have to have the courage. Or are you going to buy and hold an investment and let it wait? Okay, you wait and then you wait until it becomes more valuable in the future. So that is another way that you could invest in the stock market. Or basically, you could use the dollar cost averaging. That means you don't care whether or not the market is up or down. You keep investing at a constant amount, at a constant interval, and that will average out your price. We can discuss this tomorrow on investment planning section. Now, you can also do diversification to reduce your risk. Okay, because so just now the dollar cost averaging helps you to do when to invest. You don't care when, you consistently do. Okay, so that will help you to answer the question when to invest. Now, this will answer what to invest, right? Because if you diversify your investment, then you don't have to worry about what am I going to buy? Is it risky? So you spread out the risk. You buy something that is low risk, high risk, medium risk. So you spread out more investment, and it has to be low correlation. That means let's say when the petroleum price increase, Asia stocks may go down because their cost has gone up, right? But the petroleum companies will go up because their profit will become more because of price. So petroleum company and your flight companies will be negatively correlated or low correlation. It's not much. So that what happens is if this goes up, this goes down, or this goes down, this goes up, you're still making money. That is more important in that situation. Okay, again, what are the steps in investment planning? Always go back to your client because at the end of the day, you are determining what to do and how to achieve your client's objective, not your objective, right? Your client's objective. So find out where they are now and where they want to go. Always remember the concept. Point A, point B. Point A, where are you now? What do you have? What are the things you want? Where you want to go? Where is your point B? How long are you going to achieve your point B? That is what investment planning is about again. So, in order to know what is your client's current position, again, from where? From your personal financial statement, from your cash. So, that is why those personal financial statements is very important to know where you are at the moment. Then walk with them, talk to them, where you want to go, where you want to go from now, how long you want to achieve. Let's say he wanted a children's education fund. How long? How old is your kid right now? 10 years, 15 years? When do you need the money? So all these things will much be able to identify and talk to your clients and then meet it. Find out what you have right now, project it so that you will know what they have. And if it's not enough, that is where you come in. Teach them, guide them, and lead them to walk and work towards the target that you want in the years to come. Okay, develop your financial plan, then selecting the investment portfolio. So as a planner, you must know. Let's say you found out that the objective is you need a 5% return. So you already must think, what investment will give me a 5% return? Or if you have worked it out, your I needs to be 12%. So what kind of investment will give you a 12%? So all these things, as a planner, you must be able to identify. Okay, on average, we're not talking about you having a very good prediction on average, because most of the time your client will engage planners to do a few things. Retirement planning, 10 years, 20 years, 30 years. So you have that much time period to actually plan out certain investment that you, on the long-term average, will give you 12%. All right, so these are some of the ways to determine the time horizon matters. Or let's say he wants just a 5%. Also, maybe bonds will be possible, or maybe certain unit trust is still possible for 5%. So you must know what are their income needs. What is their risk profile? Can they take certain risks? Are they into derivative market, let's say, or gold, or things like that, who are volatile, not futures market? So, but if their risk profile is risk adverse or conservative, then we can only promote, or or maybe some balance fund or unit trust or managed fund. So it again depends on time horizon, depends on objective, and depends on your risk profile. Okay? Or of course, you need to monitor, see whether the objective is met. So your additional rating for investment planning will be all this, but not to worry. Most of these we will be able to cover in day 3, which is investment plan. Okay, so far, any questions, anyone? Before we move on. All right, no questions. We can move on to the next. Yes, we are actually going very fast because basically the concept of a capstone is that you already have been exposed, if not to all, but most of the modules here in financial planning, meaning you have a working knowledge of all the, what we do in capstone is just to polish what you know, or add on whatever that you are still in doubt for, so that you'll be prepared to move into financial planning in total, okay, including all. So we will strengthen those areas that you already have experience in. And whatever that you lack of, we will try to fill in. But we couldn't do that in a standard way, because I believe that most of you will come in at a different phase of financial planning development. Some of you are very apt in, let's say, investment planning because you are former broker or unit trust agent or investment person, or some of you are very apt in protection planning and insurances, So you all come in at a different pace. So I have to go on to just give you an overall view of financial planning as a whole. Okay, so we will approach that way. Okay, let me see what is next in your list. Okay. Let's talk about retirement planning then, since we are. Let me share this slide again. All right, let me again push this out. This is retirement planning. Okay, retirement planning. Let me share this. All right, if any point in time you cannot see the slide that I shared, do let me know. Okay, so this is retirement planning. We will be talking more about the retirement planning tools and the process. So your retirement is the state. So this is module 6. Again, it will cover in detail when your day comes or module. So I'm just taking you for a quick tour. That is what we call in Chinese is riding the horse and looking at the flower. Okay, all right. So retirement is the state where you have retired and you can no longer utilize uh, 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 your skill, your knowledge to actually generate the income. So why do we need to plan now? The concept here is a lot of people do not actually retire according to their age anymore. Basically, they just retire according to their ability. That means I am going into the concept that why do I need to retire at 55 or 65 or 62? If I can retire right now, I have enough income to cover the rest of my expenses, I might as well retire now. So basically, we have a different a group of people now that they do not wait until the retirement age to retire. That is one concept. The second concept is we have increase in life expectancy. We have leaders who are 70, 80, 90 years old now. We have people who live to 100. So the life expectancy increase, basically, we will talk about from your retirement age of 55 till you are 85 or 95. We're talking about you need your retirement funding for like 30 years, 40 years, and that's a long time. So again, increased life expectancy would also necessitate that you need to plan for your retirement even right now, because you count back, if you need your money by 55 for the next 30 years, 40 years, don't you think that you also need to accumulate 30 years, 40 years before, right? So to balance out, right? So definitely you need to, even the day you step into the workforce, the day you earn your first dollar, whether it's from business, whether it's from income, basically you already need to plan ahead for your retirement. And that is how it is important. At the end of the day, you want to retire by design. Retire by design means that you determine when you want to retire, how you want to retire. By default is the moment you achieve age 55, your birthday, your boss will come in and say that happy retirement, give you the letter and say bye bye. Right? That is by default. You don't even know what hit you. You already hit age 55 or age 62 and you have to retire. Okay, you have no choice. But by design means that I decide when I want to retire, how I want to retire. Okay, so that is what we try to achieve. So your retirement planning process is a very broad steps. Of course, there's a six-step retirement planning process which will be covered in detail on module 6. But what is important is, again, know your point A and point B, where you are right now, where you want to be, how you want to do it. So all this is under the broad process, financial objective. What do you want? When do you want to retire? how do you want to retire, how much you want when you retire. So all these things are under financial objective. Then find out what is your funding plan. Find out what you have right now. What are the things that is actually designated for your retirement? How are you going to move towards that? Is it enough? Not enough? What are you going to do? Right? So that is the funding plan. And when you retire, upon your retirement, where are you going to put your retirement funding in? What type of investment you're going to put there so that you will earn income and yet be able to use in your retirement age. That is the consumption. So your retirement process would then be these three. So if you can see, retirement planning in financial planning is the longest term. All right. And you'll be working with your client for that many years. So that is why you need to maintain the client planner relationship. So this is the 6 steps, goals and objectives that I'm also very familiar. Again, this forms the basis of all your modules, how you want to do this, looking at this. All right. Find out, go and gather information, analyze, and then prepare the plan, and then execute the plan and monitor the review. So it comes up again and again and again and again because this is your proper steps. It is also constituted into your charter, our RFP standard is already there. Okay. Now, this is how you determine your required fund, the 6 stages of determination. First of all, find out what is your first year retirement income. Is it going to replace your, let's say when I retire, I earn the last income that I earn right before I retire is 10,000. Now that I retired, I need half of it. So if you use that concept, it will be called ratio replacement. Replacement ratio, 50% of my last long salary. That is how you calculate your first year income that you need for your retirement. That is, or you base it on your needs. Let's say you think that I need 3,000, I need 5,000. So that is your needs, expenses method. That is how they differentiate that. So that is what you need for the first year, right? Then you determine what is the lump sum that's going to retire. Let's say if I retire at age 55, I need that fund until I'm 85 for 30 years. So how much should I need when I'm age 55 so that I can draw 5,000 ringgit every month for the next 30 years? So you count back again is your calculator concept. All right. What is the calculator concept? I think that one I leave it to the retirement planning module to talk. You have to calculate what is the lump sum that you need today so that it will dwindle down to zero, having all your monthly payments for that duration of 30 years. So you also need to determine what kind of investment that you're going to put into your retirement funding, where are you going to put into, right? So that you can generate that kind of income. Okay, so that is your stage 2. Stage 3, then you identify what are the things that you have right now. EPF, your own savings, your PRS account. Are there any stocks and shares? Are there any insurance cash value? Are there any cash value in your investment link plans? So those are the things that you need to find out. What are the things that is to be for your retirement? You do not take everything because I'm sure some of you may have dedicated, okay, this property is for my son, so that would be estate plan, okay, legacy planning, or this money that I put aside is for my children's education, so I don't touch this. So there are certain things that you need to identify and earmark it for your retirement. What is for my retirement? That is the thing that you need to project. Today, it is worth 500,000. What it will be when I retire at age 55, 20, 30 years from now? That would be your source of retirement funding. Is it enough? Remember, in stage 1 and stage 2, we really determine what is the lump sum and the retire. So I project what I have right now to how much it will become in the future, compare that to what I need, and that is where you get your stage 5. Okay, so you identify what are your current resources, project it to your retirement age, how much it will be, compare what you need and what you have. That is your gap. That is your deficit. If you have surplus, very good, very well, you can even retire. But if you have a deficit, what do you need to do? How much is the deficit? With that, you then calculate how much you need to save today so that it will become the amount that you need in the future. Again, retirement planning is all about your own self, your current self, helping and investing for your future self. Very important concept. So you must do it right now because if you don't do it, nobody else is going to do it for you. We are all sendirian berhats. Basically, we are sendiri and we are all berhats because we have limited resources, we have limited time, we have limited money. So please take care of yourselves. Okay. Review of investment. Now we need to, since we know that you need to grow money into a certain amount in the future, so we need to know what are the things that you're going to invest in. How? You need to monitor what are the things that you have invested in. How are their performance? Look at their report. Then you compare. Does it meet what you need? Is it going to project to the amount that you need? So you need to monitor all these things. If you need 5% growth and you notice that your portfolio is not performing to par, not going 5%. So do you need to adjust? Do you need to buy new things or throw away those non-performing items? So all these things you need to evaluate, you need to review. Okay. Once you review, it can be initial, 1 month probably, or yearly or monthly, depending on how and what kind of investment you're talking about. Or it can also be an impromptu, that means ad hoc. You need it right now. What's the example? I got a new child. Also, you need to re-evaluate all your priority because then you need to cater for his education planning, right? So there's an additional changes. Or suddenly he said, oh, I got a promotion, very good. That means he can save more. Or maybe he's like, oh no, I got fired from today, I got retrenched. So we need to resit what is my investment portfolio, what are the things that I can liquidate right now because I need the money back. So there are so many things that may happen and so many changes in life that may trigger the impromptu or ad hoc review. So these are the few things that you need to understand. So what are the obstacles for us to save for retirement? Very simple. Basically, you have a tendency to overspend. So that is an issue. Okay, very interesting. Just now somebody asked me about uh, dual income. Okay, you have a few approaches. One approach is to find out when do they retire. Are they going to retire together? If both husband and wife is of the same age and both companies' policy is to retire at the same age, let's say 55 or 62, both also 62, then you can actually plan together as a combined. But let's say the husband and wife has an age difference, okay, a few years age difference. Somebody will retire first. So is it wise to then put separate or combine? So it's up to you again. It's up to you with the understanding and the approval by the client because they have to decide how and when they want to retire, right? So that is one concept. Then the second thing is also basically, does the husband and wife have separate uh, accounts? Do they have separate businesses? Do they have separate incomes? That is also another point of consideration. Can you actually split it? Okay, so if let's say if the husband's income is very much larger than the wife's income, do you want to combine it or you want to separate it? So it is all depending on the husband and wife situation. There's no hard and fast rule. That depends on whether they retire together or they retire separately. So we need to plan separately. Okay, so I hope that explains and answers your question. All right. Unexpected expenses and reduction in income. Basically, that is also very prevalent, especially when you have an emergency, and then you don't have enough emergency fund, then you eat into your investment, which was to cater for your retirement plan. So that may also cause your saving to reduce or investment to reduce for retirement. So how do you do that? You set up your emergency funding. Okay. After competing other competing long-term finances, down payment for house lah, children education lah, any other thing that is not your retirement. So what you do is you set up a fund especially for your retirement. So you have different jars. This jar is for retirement. This jar is for emergency fund, education fund. So you can also help them. Okay, this trust fund, this unit trust is for this unit trust is for this. So you set up dedicated fund for each of the component of your financial planning. Very important. I'm not the host. Somebody please. The host has to mute that person, but try not to on your mic. Okay. All right. Long-term financial objective, and research has found that EPF alone is definitely not sufficient. There are more than 50% of EPF withdrawals that is made by retirees. They finish off the whole EPF fund in just 3 years, which is actually quite sad. Why? Some of them took it and then bought a new house, new car, new wife. I don't know what they do with it. But basically, they run out of EPF funding even in the first 3 years. Can you imagine your EPF funding is supposed to last you for until you are 85, 95, 100 or bye-bye. But you have actually exhausted all the EPF funds. So definitely EPF alone insufficient. You need things like PRS, you need additional unit trust investment, you need all your insurance cash value, you need every single thing that you contribute to your own retirement. Okay, we're very interesting concept is this. Can you imagine if you are to retire age 55 and you expect to live only up to say 80? So that is already 25 years. But you look back at your age, you look back backwards, from your point of 55, you started, let's say, at age 25, right? 25 to 55 is 30 years. But when you started, your income was very low, isn't it? So you have 30 years to accumulate for your retirement fund for your next 30 years to use. You already know that definitely is insufficient. I don't even have to calculate. In conceptually, you already know. I have that less and I'm only saving 23% of my income for the past 30 years. How can I meet 50%, let's say financial ratio, of my next 30 years? All right, so that is already a very good indicator that just basing on EPS savings, you will never have enough savings for it. You need to do that. You need to really do that. Okay. So some of the retirement benefits that we have. This one basically.
Mr. Tay, Mr.
Yes.
Tay.
Sorry. Yeah.
Yeah, can we just call out the name? Lee Xiu Shen. Lee Xiao Shen. Can you mute your mic, please? Lee Xiao Shen. Okay, she's not there. Fine.
Oh, okay. Never mind. I hope everybody can hear what I say. I will have to talk louder than them lah. Basically. Yeah. Okay. All right. I can't really see the participants. Sorry, when I'm full screen, I can only. So you help me to monitor some of the things, whether you can see the screen. If you cannot hear me or you cannot see the screen, please let me know. And if some of them maybe they forgot to put the mic, so maybe them. Yeah. Okay, thank you. All right. So basically, retirement benefits. Sorry, what did you say? Okay, never mind. So you're considering when you design certain retirement benefits, actually most of the companies now do not have a retirement benefit anymore. Most of the time they will actually just contribute to EPF because it's simple. Your EPF is a defined contribution scheme. That means you already know, okay, 11% of salary and the boss gives you 12%. So it's fixed, all right? So it all depends on your salary rate. It is no longer a defined benefit. That means last time when you work in the government service, basically you get a pension after 30 years, 15 years of working, and then when you retire, you will earn 50% of the last drawn salary, right? And that will be the pension scheme. Certain big companies like Shell, British American Tobacco, Nestle used to have that kind of pension scheme. But because of the cost of running a pension scheme is very expensive, you have to pay that person until he goes as well. After that, when he goes, you pay to the spouse. Okay, so that's why it's getting very expensive to run pension schemes. And now even some of the government agencies are already moving towards EPF. Okay, so yeah, that is fairer in that sense that because this is how much you earn, this is how much you put in, and this is how much you will save, and this is how much you will get when you retire. So pension scheme, very expensive to run. So everybody is now moving towards EPF. Okay, and EPF not insufficient, go for PRS. Very important. This will be taught at retirement planning. Okay, so this is some of your retirement scheme. You can get a tax allowance of 3,000, not tax allowance, sorry, a tax relief if you actually contribute to a PRS at the moment. It's still on until and unless the government said, oh, we are no longer supporting this, then it will be taken up. But at the moment, you can still invest up to 3,000 and get tax relief. The 6,000, you're actually sharing with your EPF and insurance. So that one, most of the time, we already max that. Okay. EPF, this is some of the things you can actually look at. One thing, www.ksp.gov.my has a very good graphical information on all this that I'm sharing here. So please do take a look at your EPF. PRS, Private Retirement Scheme. It is a parallel running voluntary scheme for you to save for your retirement. It is actually unit trust, but these unit trusts are special. It's run by approved providers, Manulife, Public Mutual, Maybank, AIA, Pru, and some of these insurance companies, they run all these PRS. Actually, it's a unit trust, but it is meant for retirement. That means you cannot take out money until you retire. It runs parallel with EPF, but EPF is a mandatory. You must save if you earn, and it is stricter in that sense, but it is government run, that is under EPF. The private retirement scheme is run by unit trust companies and insurance companies. It's run like a unit trust, but it is meant for your retirement. So you cannot take out money. You can only take out certain money. You get an 8% penalty if you take early withdrawal. Yeah. Yes, I think it's until 2021, if I'm not mistaken, and somebody has highlighted that. Yes, there is a time limit, so make full use of it. This year, there's still 3,000, and this year, I still have 3 months. So you can actually get a 3,000 tax relief if you invest exactly 3,000 into your PRS. You can set up under the, first you need to set up a PPA account, and then you need to choose which investment house you want to invest the PRS with. The PRS website is www.ppa.my. You have a parrot at the website. That is the mascot for your PRS. Also, a lot of good information is inside the website. So EPF is www.kwsp.gov.my and PRS is www.ppa.my. So that one, it has a lot of information about PRS, how does it run, Okay, just now we talked about the defined contribution and defined benefit. Defined contribution means that you contribute a fixed amount of salary or a percentage. So EPF is a defined contribution. Defined benefit is a pension scheme, meaning they already tell you, okay, when you retire, this is what you get. So it's defined benefit. Okay, that's the difference. Pension schemes, again, maybe I will not, because seriously speaking, right, at the current moment, only the government is running a pension scheme. I doubt so there's any corporate. If there is, tell me, I'm going to join that company. This is really very difficult to run a pension scheme. But these are some of the things that you need to just skim through. It's in your notes. Okay, this is PRS. I have all this under here. Private scheme. So private mandatory is a government pension scheme. And then it comes into private mandatory. That means it's compulsory, but yet it is private. So it's EPF. Okay, mandatory private pension scheme. And thirdly, the third pillar is voluntary schemes. That means you yourself put into a private pension scheme called PRS. As long as you put money, it's okay. You can don't put money, it's not like insurance. It's not like EPF. EPF, you don't put in money, they will fine you. Insurance, you don't put in money, it will be lapsed. Okay, but PRS is like a unit trust. You just put in whenever you want, whenever you like. It doesn't lock, but the money is locked in until you are 55. Okay, that is the concept. All right. So PRS, why is there a PRS? Because just now I was explaining all this I have talked about just now when we were talking about PPA. Low life expectancy increase, low retirement age, and then you have insufficient savings. So you need something to supplement your EPF. So it's a complement, it's not a competitor. It's not to say that you invest in EPF and then you cannot invest in PRS, or you invest in PRS, no need to. No, it is complementary. That means on top of your EPF, you do a PRS. Okay, so increase your retirement savings. These are some of the key components. You can look through it under your notes as well as your textbook. Defined contribution, that means no matter how much you put in is how much you will get at the end of the day, depending on whether there is growth or not. It is run by unit trust concept. Unit prices may go up or down, which means your investment will also go into the local stock market through the PRS providers. This is how it works. If you are a certain age group, if you are below 40, you didn't specify what type of funds that you want to invest in, they will give you growth fund, which is a little bit more risky than a moderate fund. If you're age 40 to 50, by default, they will give you a moderate fund. Or when you're above 50, they will definitely give you conservative by default. But you can specify and you have to sign off the form, meaning you tell them that I'm okay, even I'm 50, I can put in growth fund. Or you are below 40, but you say that I want to be conservative. So it is up to you. But by default, if you did not specify what type of fund that you want to, they will give you this kind of investment. Okay? And you can actually move from provider to provider. Yes, tax. It's not called a tax rebate. Please be careful about mixing up tax rebate and tax relief. Tax rebate is what you get if after your chargeable income, this is how much you need to pay tax, and then you get a rebate, means you cancel off part of the payable. Tax relief is before you compute your chargeable income, you can deduct out from your total income. That is tax relief. Okay, so please be careful, especially as planners, when we talk about tax rebate. But yes, PRS is until next year, hopefully. But after that, beyond that, we will not know whether that's still there or not. But it's to encourage people to invest in. Okay, so if you look at this structure, this is the PRS structure, it works exactly like your EPF. Account A is your account 1 in EPF. You can only withdraw at retirement age. So once you put in, that portion of your investment can only be withdrawn at retirement age. And account B, 30% of it is in account B, that can only be withdrawn, but you need to pay a penalty of 8%. So that is like your account 2. Now, account 2 of your EPF, you can take out for certain things, your education, your children's education, your medical fee, your children's medical fee for critical illnesses, so things like that. Or maybe you can use it to buy your house or pay for interest. So that's very flexible. But this account B in a PRS is actually quite strict. It is will be subjected to an 8% what do you call that? Yeah, penalty if you withdraw early, right? Okay. Tax exemption is provided on income received as well if you have an income. Yep. You can actually keep your money in your EPF even after 55 years old, because basically they have a goal. Even if you are earning money after 55, you can invest in a golden account scheme or something, which I'm not too familiar, which means you can actually keep, even when you retire, you can have a few options. First is you can either withdraw everything if you think that you can earn better than your 5% or 5%. Secondly, you can maintain the money there and you only do monthly withdrawals, also possible. Thirdly, you can convert everything into an annuity scheme, which they will pay you until you go. So there's a few options, very flexible. Again, please go to your EPF website to find out what are the benefits that you get as an account holder. Right? If you are working and you're still contributing to EPF after you are age 55, there is a certain called a golden scheme or something, which they will continue to pay dividend. Even if you keep your money there, they will continue to pay a dividend. So it's a very excellent thing. All right, PRS, that is PPA. PPA concept is to be the central for all your accounts. So that is why this allows you to move from one provider to another. Okay, the provider only manages your fund held by the trustee. The PPA is the one that holds the public-private administration. I can't remember what the PPA is. but it's an administrator to hold all your accounts. Okay. All right. This is under the Capital Markets Act. These are some of the things. So the company must always tell you what is happening to the funds. Annual report must be issued. Okay. They must tell you what are the investment strategy, what are the risks, all the fees and charges, whether it's trustee fee, administration fee, management fee, they have to let you know how much they have charged to the fund. Other schemes, again, could be pension scheme, or maybe there's ESOS, maybe there's pink forms, there is an allotment of shares, you don't need to buy, you don't need to exercise, they just give you listed. So some of the schemes that is how they try to keep the staff, right? You can only, like let's say you can only exercise a certain resource on certain years, or you allocated a certain amount of shares when you have service 5 years, 10 years, or every year you are there with the company, they give you a specific amount of shares. So these are some of the things that they allow you or to keep you as a staff. All right. Maybe retirement, they will pay you. Retirement, some retirement gratuity. Okay. You have to find out how much and what company does that. Not all companies give you gratuity scheme. So again, how do we overcome our inadequate retirement resource? Very simple. You could actually readjust to simpler lifestyle. Many of my older clients actually they sold off a bigger house. They use the cash, they buy into a smaller house because it's only two of them, all right? And then they use the excess cash as a retirement funding. So that could be simpler lifestyle. You don't need such a big house, or you used to travel around, travel around, spend a lot of money on vacation. Maybe you can cut down on this. So this is all depending on the retiring couples. It's again your client's objective. Okay. Maybe you could delay retirement. Some of the parents now, because they are late parents, means they had their younger children at a very older age. So now, when they retire, their children are still schooling or still in education. So basically, they need that extra income for their children's education. So they delay their retirement. They will tell their boss, I'm 60, I'm supposed to retire, but let me sign another 2 years. Let me be serving as a contractual worker or something like that. So you can delay your retirement to adjust to the a lack of retirement resource. Or you can even work. Maybe you can be a consultant and advisor somewhere, where they value your experience and skills and knowledge, right? So you could also do that, or even part-time or some project basis, yeah? Or you try to make full use of what you have. If you have not much, maybe then you will cut down on other expenses, or maybe I would invest in something that will give me a higher return. So those are some of the things that you could do. Okay, so additional, right? Again, this is the website that will tell you all our PRS, ppa.my. That's about all. Oh, sorry. There's an appendix 1 in your the chapter, if I'm not mistaken, chapter 8. Yeah, so do take a look at your notes again. But again, take note that the notes there may be outdated, so you need to go up to the website to find your latest information. Very fortunate, all of us at the moment right now, because it's Google and things are there. All right. Okay. Lenovo, this private retirement scheme, yes, they are making use of the spread in your deductible tax. What happens is this. Technically, the company can give you up to 19% EPF on their side, but most of the company now only give 12, which is mandatory. Some company give 13, 14, 15, depending on. Now, if it is up to 19%, meaning, let's say they give you 12%, from 12 to 19, there's about 7%. So in order for me to keep my best and good employees, I give them the 7%, but I give them into the PRS. And it's a guarded PRS, meaning if you have not served me for 5 years, you don't get the extra 7% portion. You will only get it after you service my company for more than 5 years, then I will put it into your personal account. If not, it will be a dedicated account under the company. So some companies do that. Because whatever money that I give to the employee provident fund or a PRS, up to 19% for the company, I can write it off as an expense from my profit and loss. So instead of paying tax, I'm giving to my employee, say, so that it cuts down from the profit of the company, but it is given as a benefit to you. So staff benefit, staff retirement schemes, EPF schemes, PRS schemes, it is deductible from their profit so that they pay less tax. But the EPF and retirement portion, which includes PRS, is up to 19%. So any company can make use of the difference. Let's say now they give you only 12%. They can make use of the 7%, put in another scheme, or they can even pay EPF up to 19%. And this whole 19% that they pay you can be deducted from their profit. Okay? All right. I'm sorry, what is the slide that you're referring to? Anyway, you can actually take a look at the notes under the EPF section, as well as the PRS section, which explains what I have said this time. Okay. In relation to taxation as well as retirement. Any questions so far? If not, we can go on. We are already at 3:30. Let's take a 5 minutes toilet break. Some of you rushing off to. Okay, we can withdraw from employees who don't meet the requirement. I didn't get what the question. That's even a reverse when PRS contribution is withdrawn from employees who don't meet the requirement. Oh, it is already into their PRS funding. They already write it off from their tax payable for that year. So it will remain there because it can also be used for the other employees, the newer employees or those who qualify. So it will become actually a sort of like a consolidated fund under them, which they have already deducted from their tax anyway. So they will remain there for other. It's just that you who left the company or you don't meet the requirement, then you don't get it lah. But it will be a consolidated fund under them. They will only pass it to you to become part of your PRS when you meet the requirements. If not, it is just kept as a consolidated fund under them. Okay, I hope that answers your question. Yes. Technically, it is, but it is dedicated. We call it. There is a term. I forgot about the term. Some of you may want to sit for your PRS exam. There is a term. I can't remember what is the term called. It is actually is it a dedic? I can't remember the term, but it's kept under the company's name until and unless you meet the requirement, then only we transfer it to your personnel. Oh yeah, vesting. Thank you very much. Thank you very much. Yes, it's a vesting account. Yes. So it's vested under the company. Is their is still theirs until you meet the requirement. Okay, I go for your toilet break. Now it is 3:29. Be back at 3:35. Yeah. Okay. Okay, we are at the next topic. Hope everyone is back. Okay, let's move on. Basically, this is the estate planning, which you would also cover later in the days of your module, RFP modules. Estate planning is one of the modules that you would cover. So estate planning would be defined as the process of managing. The key word here is managing, meaning we are talking about having to manage and administer the asset. So the concept is this: when we are alive, everything that we own will be considered as an asset. Now, these assets, when we pass on, it will be considered as an estate. All right. So the estate is actually used to be asset, but now it has become a legacy estate. Somebody has passed on. Okay. But you have to be careful about the definition. Why do I say that? It is the process of managing and administrating your asset of the individual through the accumulation as well as conservation and distribution phase. Does it say before or after death? It actually doesn't now. So it means that even before that person passes on, you already need to do estate planning. Because once the person passes away, what estate planning are we talking about is really dead, right? So this is the concept that we have to register. So why and how? It must be in the most effective and efficient manner possible. So you have this concept where when you started off, this is the financial planning life cycle. When we started off, we are accumulating our wealth, right? There will come a certain point in time where we have to conserve this wealth so that at one point in time, so this point, which is the wealth distribution, starting of the wealth distribution, this point in time, okay, this point in time, basically is where we start to distribute out the wealth, whether because we need it as an income replacement for our retirement, or this point could also mean our death, and therefore we need to distribute it into for your beneficiaries. So this is the concept. All right. So this is the concept of your personal financial planning life cycle. So what is the definition of what consists of estate? Your estate is your property and property rights, rights to the property and the property itself that you own, that you actually own. That means whatever you owe, you must net it off. You cannot pass on your debt. You can only pass on your asset. Let me repeat that. You can only pass on your asset as an estate. Your estate will be net of debt, right? So that is the concept here. So it will cover your tangible assets like land and building, your personal jewelry, art collection, or whatever else that you used to own. It could also mean your car and etc. It could also mean intangible asset, which is your copyrights to your books, life insurances and all that. So those are those intangible assets that you inherit. Or it can also be rights, royalties, right to damages. You can inherit other people's debts to you. That means if somebody owe you money, you can actually pass it on as an asset to your beneficiary because they owe you money. But if you owe other people, before you pass on your estate, you have to already clear off the debt, right? Now, right to damages, like let's say if you sue someone and in the midst of suing him and the court awarded you money, but the money hasn't reached you yet. So it's not doesn't form part of your asset, but you already won the court case. there is money coming to you, but it's haven't been credited into your account yet, then you could actually pass it on to the next beneficiary so that the person who lost the court case to you will now pay your beneficiary instead of you because they're no longer around. So you pay to your beneficiary. So you can also inherit rights to damages that is claimed in an action or insurance payout or a claim, for example, which your deceased hold at the time of his or her death, right? So that is what it means. Okay. Now the interesting concept is the book Peter Pan was written by a very famous author, J.M. Barrie. So his estate states that from his point of death onwards, all the copyright fees that is supposed to pay to him for his book Peter Pan, and you use the character Peter Pan, you use the book Peter Pan, you print the book Peter Pan, you need to pay copyright to him, yeah? That money is given to the London Street Children and Women Hospital. No, sorry, the London Street Children Hospital. Right? So you could also pass on your estate to an organization, to a trust, to someone else that is totally not related to you. It is all pretty legal. Okay, so this is how estate planning is. Now, the purpose of estate planning is to ensure that when this person passes on, you will have enough asset to meet the objective. What are your objectives? The objective is to give to someone, right? To pass on to beneficiary. If you do not have any asset, what are you going to pass on? Yeah. So you must ensure you have net assets, net estate. Again, that relates back to your personal financial planning. If we have done a proper and good financial plan, basically there will be assets to be distributed upon your client's death. Definitely. If we have done a bad job, obviously by the time he dies, he will have no asset to pass on to his beneficiary. Right? So again, your accumulation phase, your conservation phase is very important so that you would have something for your estate. Yeah, that is what we mean by assets are sufficient to meet your objective. Your beneficiaries will receive your asset in the proportion and the manner that you desire, meaning you will already plan it so that, oh, my first son will get this, my second son will get this, my third son will get it. Because if you are gone, if you pass on, nobody knows what is your intention, right? If you have not planned it well, who will get what? Your first son and second, and three of them will be fighting over your estate, and it happens a lot. If you are not the wealthy, then maybe it wouldn't happen so often. But if you are talking about billionaires or millionaires with thousands and millions of money in the bank and a few properties, I'm sure the descendants, if you have not planned your estate properly, are going to fight over who gets what. All right, so that is something that we need to be very careful about. And asset depleting expenses like taxes are minimized. Okay, so for us, we do not have inheritance tax. We also do not have estate duty. So basically, we are passing on a net asset to somebody. But of course, if you have real property gains tax, or something like that, if you dispose of certain property, but they will have exemption and all that. All this will be discussed in your estate planning module. But there are things that we need to consider, and taxes is one of the main consideration when you do your estate planning, right? Now, you also need to have certain cash in your estate so that you need to pay for your stamp duty, the lawyer's fees, the many transfer and administration costs that you need to do, because even your final expenses, for example, now Nirvana also not cheap, talking about 18,888 or 8,888, for that kind of funeral services. So those are those things that you need to consider even in your estate planning. Enough liquidity to pay for all these things. All right. So property ownership related to your estate, because we need to know what kind of property you can inherit, what kind of property you can pass on to your beneficiaries, because you can only pass on full ownership properties. You have unlimited interest when you are alive and also upon death. Right. So these are the individual fee simple outright ownership that you can pass on without any issue. You cannot pass on life interest. Life interest means that you have the right to possess, use, and derive income from a property, but That is as long as you live. Once you are gone, your ownership rights ends and it goes back to the rightful owner. So if you have a life interest property, upon your death, you no longer have control and you can no longer pass on this property. Right? You also may have term interest. Term interest is something like you have a leasing agreement for 10 years, 20 years. You also cannot pass it on unless it belongs, you have signed the contract through your company. The company didn't die, only you, right? So maybe you can continue that because the company is still, yeah. So these are something that you cannot uh, pass on. Okay, for future interest, maybe you have the right to enjoy a certain property happening on a certain event, but it has not happened yet. So you also cannot do future interest kind of beneficial because you don't know what will happen. Okay, now in Malaysia, there are a lot of people very confused about joint ownership, and they always thought that you can actually inherit somebody's property if you have a joint owner, but it is not true. Let's say you have a property here, Mr. A and Mrs. A, so A and B. Let's say they have 50% over the property. So many people think that when A passed on, the wife or the husband, depending on who dies first, will inherit the whole portion of the property. Okay, well, that is true only in Singapore where they have joint tenancy. The key word here is this word. This word. Oops. Joint tenancy. Yeah, joint tenancy with the right of survivorship. That means in the event A passes on, if there is a joint tenancy or right of survivorship, B will automatically inherit the whole property because there's only joint name A and B. Okay, but in Malaysia, most of the property, if I'm not mistaken, is all of the property is under tenancy in common, which is without survivorship right. What do we mean by probate asset? That means you need to go through the courts to get the portion of the deceased, even though it is a joint account or a joint property. Okay, the joint property, A portion will go to his estate to be distributed either according to the will or according to Distribution Act, which we will see the difference. B does not assume the full right. He or she has to go through the courts to get this part of the property, but he or she can keep her portion of the property. This is tenancy in common, and it is very common in Malaysia. So be careful when you come through this. Most of your clients may not be aware. They think that, oh, joint name A and B, the husband dies, then the wife will get. No, this portion will be distributed according to the estate and according to the estate law. So this is something that you all must be careful about. So if you can see, the above classification of your property is generally based on your owner's rights exercised over the property, whether he has full ownership or he has term ownership, and also the duration of the owner's interest. Okay, now again, if you look at this is the same thing over and over. So in estate planning, the same thing. Establish what your client wants for his estate, what and when he wants to distribute it, and to whom. Find out who are the beneficiaries. Then look at your fact finding. Find out what kind of property. Is it outright? Is it the term? Is it still under mortgage? You cannot actually technically pass on your house. This is still under loan, it is still under mortgage to your beneficiary. You have to settle your loan. Whether or not the bank will ask your beneficiary to continue to pay for the loan is another matter altogether. Technically, it's not possible, but they will need to restructure the loan. Now the new payer is your beneficiary. So they can do that, but it must go through the courts. Whether you have a will or not, you still need to go through the courts. Many people also have the concept that, oh, I have a will. You cannot take your will and go to all the agencies and go to all the banks and then they will transfer the name to you. Your will need to be proven, need to go through the probate process in the courts then the courts give you a grant of probate based on your will, then only you can take that grant of probate to all the banks and all the agencies to get back the money and everything else. Because your will in itself will only facilitate your application of the grant of probate. And if you do not have will, you need to go to the court, tell the court that I do not have a will. And they will follow the Distribution Act for non-Muslims and to distribute your wealth. So that is something that you must really, really take note. The difference between having a will and having no will. Okay? So all the things that you need to analyze here, basically, whether then you, depending on the property, depending on who you want to give, depending on how your transfer want to be done, then you need to decide, are you going to do it through a will? Are you going to do it through a trust? Or are you now already give them as we was give the living gift, now give away already, I don't want you to give it to them. So it all depends on what type of property and what is your distribution concept, how you want to distribute your wealth. Okay, then you need to develop the plan. Always remember to do plan execution. A will that is not signed is not a will. It is not legal, not valid, and cannot do anything, right? So make sure you execute everything. Make sure if you want to form the trust already, because when you are gone, you can no longer do it. So these are some of the things that you need to be very careful about on plan execution. And again, you need to periodically review because you have different assets. Some assets you have sold, some assets you have settled, some assets you are no longer in your list, or you have new beneficiaries coming in. So there is a lot to review. Every time when there's a change, you need to review. Okay, so beneficiaries will be your heirs, the thing that you want to give to them, those that will inherit your deceased property and money or whatever that you're going to give them, those are called the beneficiaries. The beneficiaries are the key object of your estate plan. That means, what is your estate plan for? Besides the person who is going to give away the money and who you want to give to. That is the objective. Who you want to give to. That is the objective of the estate plan. Okay? Fiduciaries are the person that will help you either administer or start the ball rolling. So an executor, a trustee, whatever that you name in the will, is supposed to help you to distribute your asset to the beneficiaries. Okay, basic duty act in the best interest of the beneficiaries, cannot delegate away. That means I am the executor or the trustee and I ask somebody else to do my job. No, that you cannot do that. You must act impartially. Yeah, cannot profit yourself. Let's say, this one, I can have access to all the asset. I don't want to give to the beneficiaries and take all the money away. Right? So as a trustee especially, when there is money supposedly to be given to somebody else and not you, if you take that money, that is a breach of law already. Okay? That is already illegal. Okay, so that is what is meant by very important that we must act for the best of the beneficiary. Okay, right. Okay, duty of various fiduciaries, a trustee is to actually, so you can see basically a trustee have a control over all the property that is under the trust. And when I say property, it's not just like real estate property. Property means that even assets like bank accounts, securities, whatever that is of asset value in your trust is your property. We term it as trust property. So the trustee has unlimited access on because they are trusted. The name already called trustee. So you must have enough trust to give them so they hold the money on behalf of who? On behalf of your beneficiaries. That is the concept. So for your statutory, I think your estate planning lecturer will give you detail what is statutory trust, what is a living trust, what is all these other trusts. It will be actually discussed in the estate planning module. Okay, so I don't want to touch too much on this. Now, guardians are someone that you or your court, if you don't have, you can actually name someone as a guardian in your will. Okay, or if not, the court will actually appoint somebody as long as you have minors as your beneficiaries. And when we say minor in Malaysia, it's 18 Over here at Sarawak and Peninsular Malaysia and Sabah is below 21. We call it minus. So as long as they do not know how to take care of themselves in that sense financially, so you appoint guardians over them. Now, an executor is somebody that is named in the will. An administrator is named by the courts. If you do not have a will, the court will appoint an administrator. If you have a will, you have to name somebody that's an executor. So he will take that will and go and go and get your grant of probate and go and collect your estate. That is the function of an executor. Administrator does the same, but the administrator is appointed by the court and the executor is named in your will. So you can have a will, your written instrument, which you signify your wish to the distribution of your estate after you are dead. Okay, so you will tell in the will who to give, who not to give, how much you want to give, how you want to give, or you want to sell or whatever. You want to be cremated or not cremated. All this is written in the will. It is your wish, your dying wish, they call it. Okay, so that is a will. Now, a trust is when you transfer your own asset into a trust. Now you no longer have individual control over it. The trust owns your asset. You will not have any asset. And that is what we call trust. It's a third party handling that. Well, can the same person also be a beneficiary and a trustee of the trust? Well, technically, you can. That means instead of me, hey, the property is me under K, I transfer it to ABC Trust. Okay, so under my name, there's no longer any asset because I have transferred everything to ABC Trust. But this ABC Trust, the trustee is me. I can be a trustee of the ABC Trust. And who's the beneficiary? I can also be a beneficiary of the trust. That means the trust is held on behalf of me. That's the interesting thing. Why do we do this? In your estate planning module, they will discuss it in detail. Okay, so whatever property, whatever asset that has been transferred to the trust is now called a trust property. So this is the components of your trust. You need the grantor of said law. That is me. I created the trust so that I can transfer all my property over. So all your property that has been transferred over to the trust owns the property now, will be called your trust corpus. Corpus is body. Yeah? So anything of the value that can be owned and titled will be transferred to the trust. That's the property trust. The trust, the property, the trust already. The trustee is the person taking care of the trust for property. For who? For the benefit of whoever that has been named as beneficiary. And the beneficiary are the one who actually will benefit from the trust. The trust will pay money, or the trust will later transfer asset over to the beneficiary. And all this is documented in the trust deed. So in order for me to set up a trust, I need to have the trust deed. So trust deed sounds very familiar, right? Trust deed is also how your unit trust is created. That means you as an investor in a unit trust has actually transferred your money into that trust fund. That's why it's called a trust fund. And the trustee, like naming trustee, OSK trustee, whatever trustee, is actually overseeing. They are the one who actually hold the money for you. Who are the beneficiaries? The investors. The investors are the beneficiaries. So the trustee holds on that property for you. And who manages it? Your unit trust managers, the investment managers. They are the one who manage the trust fund. So if you understand the concept, that is why any unit trust that is formed, they have a trustee. And this trustee will tell you all the terms. Who will be the trustee? Who can use the fund? When you will get the benefit? Is the dividend incidental or is it fixed dividend? All these things are stated in your trustee. Okay, right. There's another instrument called power of attorney. Power of attorney is actually having someone else to act like you financially. So if you have signed off a power of attorney to somebody, that somebody can do so many things. If you look at the list of the things that your attorney, in fact, which is the person that you transfer your financial powers to, is like you, is almost like you. It is you financially. That means he can sell your asset, he can buy your asset, he can take out money from it, as long as you have a power of attorney appointing that person to act on your behalf. Now, many of you will say, oh, this power of attorney, I've not heard of it. Actually, if you ever bought a house under a bank loan, you would have signed a power of attorney. Why do I say that? This power of attorney is irrevocable until and unless you settle your loan. Why? It gives the power to the bank, the financial institution, to sell off your house if you did not settle your loan. After what? 6 months? 7 months? 12 months? All right? They have the right to lelang your house because you have already signed that power of attorney. And it's irrevocable by you. You cannot sign today, yeah, okay, and then I get all the loan, and then I buy my house, and then suddenly you go to the lawyer there and say, okay, I tear off this power of attorney. No, you cannot do that. It's a irrevocable power of attorney that you have already assigned your house over to the bank. Wow, interesting. Yeah, so this is what we call a power of attorney, so that the bank has the right, because you have signed away and the power of attorney, they have the right to sell your house if you didn't pay. Okay, so this is fair. So basically, if it is a revocable power of attorney, you can write and say that I revoke that power of attorney. You can also, the person that you assign to can also revoke it, you renounce to say that I don't want to be revoked, that you give me the power. Okay? Or if you have death, right? If you die, then the power of attorney is not there anymore. So if you want the power of attorney to be continued even after you are dead, then you name the person. You name the person who you have given the POA to in the will, so that when you die, then the will comes alive, and then you can have him to continue to have your financial powers. Okay, something interesting here. Let me share it with you to help you remember these two estate planning tool. Okay, if this is your point of death, okay, so your will that you have written right before you die, this is the point where you die. Your will is dead before you die. Your will become alive after you die, correct? Because your will is sleeping here. It doesn't have any effect. It doesn't work. It doesn't mean anything until and unless you die. Then that point onwards, your will becomes alive. Power of attorney is effective before you die, but it also dies with you. That is your power of attorney. Okay, so that is the concept. Now, if you have a trust, the moment you created the trust and transfer the property to the trust, regardless of whether you die or don't die, your trust will go on. Okay? Perpetually or forever if it is an academic, scientific, charity trust. But if it is a personal trust, it will be only legal for 80 years in Malaysia. There is a perpetuity law in Malaysia, so that you can recirculate your asset into the system again. Okay, but in US, places like US and UK, it is perpetual. The trust runs on forever. That's why you have Rockefeller Trust, you have the Prince Trust. It will run on forever, even though the creator of that trust is long gone. Right, few hundred years it can run because it's a perpetual trust right at that site. But here in Malaysia, 80 years for a private trust. Okay, you have to recycle the thing. If it is an academic, scientific, cultural, or charity trust, then it can run on forever. So remember this concept. Your will is dead when you are alive. It becomes alive when you are dead. Your POA is alive when you are alive. Upon your death, the POA dies. And your trust becomes effective and alive the moment you create and put in your properties. Until, I may say properties, including your assets, until forever, in its private trust is 80 years. Okay, so this is how you remember the three instruments of estate planning. Okay, business buy-sell contracts. This is especially true for insurance, which I will explain in detail, but in technical terms, is let's say you have three owners of a company, equal shares 33%. Okay, Mr. A, B, and C. Now, each of them hold 1/3. Let's say if one day Mr. A passes on. Okay, so in the dilemma that you have B and C to take over A's equity. But the problem is B and C does not have that much cash. All right. So what happens is very simple. In order to protect everybody, all the shareholders, B and C will buy a life insurance on A, and B and C is the beneficiaries. Then A and C will buy a life insurance on B, where A and C are the beneficiaries, and vice versa, A and B will buy on C, a life insurance, where A and B is the beneficiary. Provided, this is only allowed with two things. One, there is an existence of a business buy-sell contract within the three persons, meaning whoever survives has agreed to buy over the equity from their beneficiary so that they give them cash, because some of the beneficiaries may not want to run the company. First. Secondly, they must prove that there is insurable interest between the three of them, partnership agreement or shareholdings or whatever. Because if not, very simple, A and B buy a very heavy insurance on C and then kill him off, and then he gets all the benefits. Yeah, so that will be very dangerous. So business buy-sell contracts uses this concept. It is a point of estate planning for partnerships as well as business with kind of arrangement. There must be a business buy-sell contract executed in the lawyer's firm between the three of them. Plus, how are you going to get the funding mechanism? How are you going to get that much money? Get life insurance, right? So that is the concept of business buy-sell contract. Okay, irrevocable POA, the host die, will the POA be revoked? The answer is technically yes. The host die, the POA will be revoked. But the bank is very clever. Even though your irrevocable POA is dead, but they still have something in hand. Your title, your land title is still charged into the bank. That means the bank still has a charge over it. That means they are the actual owner of your land for your house. So therefore, even if the POA is revoked, but you as the beneficiary cannot inherit that estate, cannot inherit that property from the deceased, because the bank still has a charge. Remember, you can only benefit from estate that is net of debt. So therefore, you then beneficiary, you have to go to the bank to say that now that this person is dead, even though the POA is gone, you cannot sell the house, but I also cannot sell the house and I cannot get the house either. So what happens? I will then have to agree with you or with the bank to say that, okay, instead of this loan under my dad's name or my mom's name or whatever it is, now it is under my name. I will continue to pay for it, but you have to release the house to me. Right? So that is how the banks actually control it. But technically, yes, the POA, whether it's revocable or irrevocable, upon your death, the POA is no longer in existence. Okay, that is if you want to ask that, I hope that explains and answered your question. All right, after business buy-sell contract, that is all we have until for this topic. So if you really want to know what is the difference between having a okay, your MRTA is good because when you die, if you are the insured, the MRTA will pay off your loan, but you still need, so it will be considered as your loan is settled. Therefore, your house is then a net asset. Okay, that is how your MRTA works. The MRTA actually pays off the outstanding loan, so your house will now become a net asset. Okay, right? You understand the concept, And but you still need to go through the courts to get your grant of probate or your this what do you call that? Letter of administration if you have no will. So whether you have will, no will, then your estate planning lecturer will be able to explain in detail. Okay, for that portion. All right, since we have a little bit of time, let me give you some if you don't have any further question, let me give you some sharing on what we are going to cover tomorrow in our risk management. Because our risk management is only 3 hours, so it's pretty short for us to go through in 3 hours for about 12 topics. So I'm going to actually go into a small introduction of what is risk management and insurance planning all about. Yeah. So just bear with me because we still have about half an hour to go. Yeah. Okay. All right. So this is risk tolerance under the risk management and insurance planning concept. Okay. Everyone can see this. Yeah, I hope. All right. So what is risk tolerance? We dwell in a few things. One is the risk in investment planning, which is covering a risk tolerance. What is risk tolerance all about? Differences in the perception of risk, analyzing all the life situations that involves risk. What is pure risk and what is investment risk? What are rational and irrational thought? The different categories of risk. How do we measure risk and the guiding principle to investment risk analysis? This one are also related not only to your risk management but also related to your investment plan. So perception of risk differs from individual. Basically, for a soldier who does parachute paragliding, the paragliders or parachute jumping, to them, parachute and height is nothing. But to me, those who are very afraid of heights wouldn't want to do that, not even bungee jumping, because so that's a different perception of risk. What is the risk that I scared? I'm afraid that I may fall, is it? But to them, it's part and parcel of life. So perception of risk then differs from individuals. So for investment, risk is the concept that either you will have a chance of loss or a gain. Yeah, just like business, either you will earn or you lose money or you just break even. So that is your risk. Okay, so for us, actually, we require fact finding. We require analysis to find out what is the client's risk tolerance. And when we say risk tolerance for a client, is actually the client's capacity to face loss. That means if I ask you, how willing are you to invest in this? So my greatest fear as a client is how much money am I going to lose? Am I going to lose everything? Then it becomes a very high risk. Am I going to lose a little bit? Then it is slightly lower risk. So when we say a client's risk tolerance, means that we are talking about how much can your client lose. Always have that concept of what is risk tolerance for a client. Okay. Now, subsequent recommendation will then be based on whether your client is a risk adverse. That means I want to avoid risk altogether. I'm very scared of investing into high risk products, and then you have to be satisfied with lower gains, because again, back to the double R, low risk, low gain, no risk, no get any gain, right? So this is the concept. Now, attitudes towards risk, there's a few types of how we perceive it. It can be perceived, it can be very subjective. That means people are afraid of dog. Maybe because last time they were bitten by a dog, but we know that not all dogs are dangerous, right? So it's a very subjective concept when we say about perceived risk. We may think that wow, this particular counter is very hot, it's very speculative, so I don't want to go into certain counter. But for some people, it's okay, it's part of the parcel of life, so we can do it. So it's very much based on experience and feelings. When you have been bitten by a dog before, generally you are afraid of dogs, right? So that is subjective. Okay, it's not proven by the fact that all dogs are dangerous. Some are, but some are not. Now, we can also look at objective risk. Objective risk is factual. It is already based on reality. It is statistically proven, meaning there is significant statistic reference. Let's say, for example, you drink alcohol and then you drive. It is already proven that likelihood of you getting into an accident and killing somebody or killing yourself is very high because it's statistically significant. That is very important. Okay, that means it's very likely to happen. Out of 10, 9 people will get it. You can't even walk straight, you expect to drive straight. I don't know. This is one of the things that I am are very wary about. So this is statistical. The other concept is seat belts. Seat belts on your car. You put on your seat belt. It is statistically proven. The dummy don't die. The crash test dummy will be saved if you have an airbag and your seatbelt. And that is why when an accident happened, if you see most of the time, the driver didn't die. No, because why? There is a driver airbag, there is a seatbelt. But those poor little fellows at the back who doesn't have any seatbelt, their likelihood of dying in an accident is very much higher. So statistics are objective, it's factual, and it's based on reality. So do not grumble that you need to have seatbelts at the belt. It is for your own safety. Okay, I mean, it cannot prevent accident, but it will lower the risk of you dying. Okay, that is the concept that we have here regarding risk. Okay, now we come on to the next one is pure risk. What is pure risk? Pure risk meaning if something happens, it always will result in a negative side outcome. Okay, if nothing happens, you don't stand to gain from it, nothing will happen. For example, a pure risk is fire in your house. Your house gets burned down. Why is it a pure risk? Because if the fire happens, your house will be burned down. That is the negative side outcome. But if nothing happens, nothing happens. Your house will remain as it is. It doesn't improve itself. It won't grow higher. That concept. If the fire doesn't happen, so that fire becomes pure risk to you. Okay. So what is the negative side outcome? It must be measured by the amount of your loss. What will be your loss? So if your whole house burned down, that is a whole house cost to build up the whole house. Okay. And we also need to know what are the chances. Chances of a house being burned down is there, but it's not always likely. Okay, so this is the concept that we need to know. Pure risk, you need to know what is the amount and what are the chances that it will happen. Why do we need to do this? Because the insurance concept work on the fact that we must know what is your loss and we must know what are the chances that it will happen. Okay, so we are concerned and financial planning is very much concerned about pure risk. Okay, let's look at people's attitude toward risk. It depends on his belief and value system. Some of them, yeah, it's okay lah, it will never happen to me. Okay, and therefore they will do things that thinking that things will not happen to them. Right? So it all depends on your belief and value system. Or maybe they have overconfidence, especially in what? In investment, for example. They think that, wow, this particular share sure go up or it will sure. So they are relying on the intuitive judgment. Yeah, that gut feel that what we call. Okay. Now, you can also be misled by short run trends, meaning like let's say Bitcoin, for example. Wow, there was a time that from 7 to 14,000 and then wow, everybody, but that is a very short run trend. After that, it fell down. Okay, so these are some of the things that we all, wow, now we have a mini bull run now, of all your healthcare counters or whatever else, but suddenly you find that, oh, it's only for a few days. After that, it dropped back. So these are some of the short run trends that we have to be careful. Or you misjudge the magnitude of your risk. When you cross the road sometimes with a speeding car coming in, you didn't know that how big the damage will be or how fast the car is moving towards you, and that is why, and that is how some of these cars get crushed by the train in a train crossing. Why? Because they misjudge the speed of the incoming locomotive. Now that is something to think about. All right, or it can be a denial. Yeah, it won't happen to me lah. Some people who don't buy insurance, I would think that they will never get sick, they will never get cancer. I don't know. This is some of the denial of risk that we are talking about. Or you can also be on influence of biased attitudes. What are the biased attitudes? Illusion of control, especially what? Drink and drive, because they think that they can still control the car. That is what we call illusion of control. Right? Availability, familiarity. Basically, you think that I have been on this road for many years. I've been driving this road even before you were born, so I'm okay. And you therefore have familiarity becomes a problem. You're so familiar that you didn't take care during your drive on the road, okay? Or availability of information, then so you think that, yeah, because of all these news that say that everything is fine, COVID won't come to you, so you are, okay, I don't have to wear a mask. Some of the things that we have to be very careful. So the life situations that will involve your risk would be one is definitely your investment. Okay, you have a risk. Gambling, for example, all or nothing. That's the concept of gambling. You put in there, you earn, you don't earn, you lose everything. Or pure speculation on the investment or stock market or even career could also be a risk. Do I go for job A or job B? Or do I go for business A or business B? So all this is a risk for you in your life, okay? Or it could be a physical risk, like should I cross the street? Should I stay at home? Should I go to certain place? So these are your physical risks that you face, right? Of course, there's also social risk and probably embarrassment because somebody caught your viral video, when you fell down or whatever it is, or you said something wrong, and somebody tried to sue you. So these are some of the things that is also a social risk. Ethical risk, of course, some of the moral choices that you make, whether or not it is legal, it could be legal, but morally it may be wrong. Just like what I said, the client doesn't need a particular high premium insurance, but because you want the money, so it's a moral choice. Whether that is legal or not is another story. It all depends. So we will have whether you are a risk taker, meaning you are willing to take risks in a certain aspect only. Like investment, for example. So do not equate age, profession, and gender to risk taking. Because some people may say that men may take more risk, or there are special cases in every aspect. Okay, so there are certain what we call safe occupation, like, oh, you are a lecturer, so you will take less risk, or I'm a businessman, so I will take more risk. Not necessarily. They may be good at taking risk in business, but when it comes to investment, they are not a risk. They are still such possibility. Or they are teachers, as primary school teachers, for example, they what we term a very safe occupation in a sense. But when it comes to investment, they say that, okay, I'll go all out, I will buy derivatives, I will buy futures. There is such a possibility. So risk taker is just that we choose to take risk in a specific. But thrill seeker is different. Thrill seeker consistently seek out, and if you cannot find their risk, you create their risk. For example, is those daredevil motorcyclists who want to jump across 20 buses or 10 buses, or those who want to jump over to the next building or walk a tightrope over Niagara Falls, things like that. They are the thrill seekers. They want to go to extreme sports. So those are the thrill seekers. But are thrill seekers also risk taker in investment? Not necessarily. So it's two different categories. All right. Thrill seekers mostly is on the life situation, whereas risk takers normally specifically for investments. So you must differentiate that. Now, if you are risk taking or seeking, you will seek and see risk as an opportunity rather than a threat. The Chinese character, danger, actually has an opportunity character. Okay. Now, you either have risk indifference, that means you don't care. You are okay whether it's dangerous or not okay. You just do not and not be bothered by all this kind of thing, whether there's no risk. Right? Risk indifference. Now, risk averting is when you prefer certainty over uncertainty. That means I want to be sure. And this would be the people, when you say they are risk averse, they are risk averting, would most probably be the ones that are still investing in FD, still investing in balanced fund, even balanced funds, investing in fixed income funds, bond funds, that kind of people who wants certainty, guaranteed capital funds, that is mostly certainty rather than uncertainty. So risk tolerance, talking about demographics, they say that age matters, possibly because when they did the research, the older people may want to take less risk because I'm nearing retirement, so I don't want to take so much risk on my investment, just in case I couldn't earn it back And the younger ones who are working will say that, it's okay, we can take more risk because we are working and therefore we can earn back that money. So that is how we see how these demographic attributes will influence your risk tolerance. Gender, they say that male will take more investment risk than female, but then of course, again, there are extreme cases where we call the outliers, this side and that side. There are people who are extremely low and extremely high. Yeah? So there are people who are not in the normal distribution as well. Okay, possible. But on the average, they say that male takes more investment risk than females. Okay? Now, birth sequence as well, basically the elder children will not take risk because they have the responsibility to take care of the what do you call that? To take care of the younger ones. So therefore they don't dare to take so much risk. Or marital status, those who are married probably will not take so much risk because they have family, and therefore marital status and family sequence. Some insurance companies for general insurance, car insurance, you know what they term? They term that if you are 45 years old, married, of a certain executive position, you have young children, most likely you are a very safe driver. That is the concept. Okay, but if you are a 21, you are driving Satria, kind of or Volkswagen GTI, that kind of car, so you are more likely to be a risk taker or something like that. So that's how they classify risk according to marital status. A single because there's no dependence. Not necessarily everybody fits into the bill. Okay, so they also talk about maybe occupation. If you're a banker, if you're an investment dealer or investment product person, so you will take more risk rather than compared to a teacher, somebody who does certain what we call the safe jobs in a sense, but not all jobs are safe in a sense. So you take less risk. So this is something. If you're a businessman, maybe you take more risk. We don't know. Again, there are different people in different groups. Wealth, those who are wealthier will take more risk. Maybe perhaps, maybe also perhaps that because they have more money. So why do they have more money? Because they are being careful. So they may not take so much risk. So it depends again. Education background. Supposedly, if you are educated in finance and economics, you should know that what risk that you are taking. Okay, so this is what we are. So how do we measure tolerance? You can either use a qualitative method. That means you ask, you find out, you analyze. But this one is very much based on the financial planner's experience. Just by talking to him, by finding out, can you sleep with the stock market drop by 20%, 20%, or maybe if today you lose all your money, you lose. So all these kind of things, the practitioner or the financial planner will try to gauge what kind of person it is by the questions that you ask, by your observation. So it's very unstructured. And it is very effective only if you are good in talking, good in asking them questions, good in analyzing their answers, right? Communication skills must be very good. So if your communication skill is slightly weaker, very hard to do a qualitative. So you can depend on quantitative. Now, quantitative is a very structured format. I think some of you may come across some forms like know your client, measuring risk tolerance, and they will ask you certain questions, then you select A, B, C, D, and then from all your ABCDs, you get a score, you get a point, and then they will know what type of person are you. Are you a risk averse, or are you a conservative, moderate, or a aggressive investor, right? Based on the questions that they ask you from the questionnaire. So after measuring tolerance, you need to find out what is the client investment objective, because all this would depend on what is your risk tolerance. How much are you willing to lose? Okay, your choice of your investment vehicles is very important. If that person is risk adverse, you will go for safe investments like FD, bond funds, guaranteed capital funds. And if the person is aggressive, very much risk taker, then you will go for derivatives futures where the return will be higher. They also look at what is the past behavior on your magnitude risk, how they have invested before. You also need to know what is the mindset towards the risk. Are they risk adverse? Are they risk takers? All this has to be taken into consideration when you recommend investments. Very important. Okay, and what are the probability and the payoff preferences of that particular client? Again, it goes back to the double R, higher risk, always higher gain. If you don't want so much risk, then you have to pay lower returns. All right, guiding principles. For us as planners, we have to be assuming that all clients are risk adverse, unless we can prove otherwise, unless the client demands not to be risk averse. That means they want to be a risk taker. So, but that has to be agreed and found out. So, good to give them a risk tolerance measurement questionnaire so that we will know what is your client. So that in case if you have recommended something that's going to lose money, basically you are already covered because the client has agreed. Okay, so communication very important. You have to monitor all the changing events. And the last point, very important, have a written and signed confirmation of the assessment as well as the client agreeing to it. Because some clients, basically when they went through the assessment, they may be, because of their own inner build, they may be risk adverse. But then they want you to invest in aggressive products, right? So they must sign on both sides. That means meaning they sign on the risk tolerance that, oh yeah, I agree that I am a risk averse person, but I agree that the planner or the investment planner or the practitioner now recommends me to more aggressive products, but I am okay with that. So that thing will protect you in case later on your client says that, why are you giving me a risk, so high risk product when I didn't agree? Okay, so that is to protect yourself. All right, so we are done with risk tolerance. I would leave the last 15 minutes. I know we have still have 5 minutes. Yeah, I will leave the subsequent time to questions because whatever that we're going to cover for risk management will be covered tomorrow. All right. Are you still seeing this slide? Can you still see this risk management and insurance planning? Okay. All right. So let's skim through this so that we know what we are in for tomorrow. We talk about financial risk just now. We talk about pure risk, that's a negative outcome. So our risk will then be defined as an uncertainty about financial loss from an exposure. So for financial planning, our main focus is on financial risk, financial losses. And what type of risk do we see? We only see pure risk. That means it must have a negative outcome, and if nothing happens, there is no benefit. Okay? So the loss will then be the unpleasant outcome of this risk. If that risk happened, you have a loss, and it must be a financial loss before the insurance can actually take a look at it. So the peril will be defined as the source of the loss, all right? And hazard is the condition that will either create that loss or increase the probability of your loss. What do we mean by hazard? If we talk about fire hazard, the fire haven't happened yet, right? But you have a lot of paper in your staircase, for example, in the building. That would be termed as a fire hazard because if fire happens, those paper that you have will easily be flammable and it increases the probability and increases the damage to your building because they are flammable. So that becomes a hazard. A hazard is when your factory is located next to a river. All right, that river itself becomes a flood hazard because in the event that there's a flood, and it's because you are located next to the river, so it has increased the likelihood that you will be flooded. And when it floods, it will be more severe than somebody higher than you. Okay, so that is what we meant by hazard. So physical hazard will be the physical condition that increases the chance of your loss. Moral hazard is when you have character defects. That's why if you are a bankrupt, you are not allowed to hold any financial license. Let me repeat that. If you are a bankrupt, you are not allowed to hold any financial licenses. Even a unit trust, even an insurance, even a financial bank, you are not allowed to do that. If you have been convicted of criminal breach of trust before, you are not allowed to hold any financial licenses again. Why? Because it's a moral hazard. Because of the character defect. It will increase the occurrence or the grievousness of the loss. So this have to be stated here at the licensing requirement. Now, moral hazard is the slackness. It's like, oh, I have bought insurance for my car, therefore I do not lock my car. Or I have bought health insurance for the hospitalization, so now I don't take care of my health. So those are what we call moral hazard. But most of your books will combine basically moral and moral hazard as the same kind of category because moral hazard can also be moral hazard. Why? Because you want to claim, I mean, you don't care about the claim, you go to the hospital and the first thing, the hospital asks you, do you have insurance? All right? And then, oh, you have, okay, then the doctor say, oh, this procedure is going to cost a lot of money. But because you have insurance, okay, it's fine, insurance company will pay me. So is that a moral hazard for us? Possibly, yeah. Okay. Now, classification of risk, again, pure risk, possibility of loss. If nothing happens, no loss. But speculative risk is different. Speculative risk is you have a chance of loss as well as gain. So we cannot insure speculative risk because we cannot insure that you will gain. We can only insure you against your loss. So insurance will therefore be concerned with pure risk. Okay? Happens, happen. Nothing happened, the insurance company is very happy because whatever premium that you paid all belongs to the company. I don't need to pay you anything. But if there is something that happened, we will pay you based on only your loss. Okay, so therefore, financial risk is therefore insurable, but the financial risk has to be a pure risk consequence. What do we mean by pure risk consequences of speculative risks are insurable? A very good example is you insure against the loss of profit due to fire. Let's say a fire breaks out at the factory, and because your machinery is all burned down, you cannot deliver the products, and therefore you suffer profit loss, unable to earn profit. That itself, the profit itself, used to be a speculative risk. But because it is now a pure risk consequence, the fire consequence that you lost, therefore, the loss of profit due to the fire, which is the pure risk, is then insurable. So you can not only insure the machinery, but you can also insure the loss of business due to the machinery going down. Similarly, if you insure your house against fire and your fire burned down the house, you can also insure against rental loss. All right. So this is what it means. Okay. Non-financial risk is therefore non-insurable because we don't know how much to pay you. All right. Okay. You have these are the types of pure risk: personal risk, property risk, and liability risk. Just run through this, very simple. Personal risk is what happens to you. Property risk is what happens to your property. And liability is when you have to pay other people for either your own negligence, you forgot to put a handbrake on your car and your car roll downhill and you knock somebody, that's your fault for negligence. Or you wipe the floor and it's so slippery, you didn't put a sign, somebody fall down, then it's your loss. It's your fault that somebody fell down and hurt himself. So those are what we call liability risk. Okay, personal risk. Again, this is what happens to you. Premature old age, all this comes with risk. Employment, no income, so these are personal risk. What would be your personal risk management? I will stop here and I will start this off tomorrow on how do we do personal risk management, because once we come into here, subsequently will all be about insurances. Okay, so I will have to stop here. It's already 4:45, so I will leave the last 15 minutes for questions and comments, and if there's anything that you need to ask regarding today's module. All right, your first question is there any more detailed current teaching on the calculation? Yes. Chapter 6, Chapter 3, all these would involve calculation using a calculator, because the calculation of your retirement funding, calculation of how to build your retirement funding, you need to have a financial calculator. But Using an online class, you have an advantage. You do not really need the financial calculator yet. You can use the app in either a simulated app in your handphone, or you can use your laptop, Excel, or you can use anything that is for these purposes of the class. For the online class, no issue. But what the only thing I need to warn you is only financial calculators are allowed in the exam for that state. I'm not too sure. I think we do have an assessment, right, at the end of the whole course. So that assessment would require you to have a financial calculator. Yes, Casio FC200V, Casio FC200C, Casio FC200, Casio FC100, as long as written there as financial calculator, you can use it. Even if you use a Texas Instrument or a Sharp financial calculator, you are able to calculate PV, FV, N, I, all these kind of things, right? You can have the financial calculator in, as long as it's a calculator, not a smartphone. You cannot use the app of the financial calculator in a smartphone because your smartphone can do much more than just calculation. So if you bring it to your exam hall, then you're able to scroll for answers. No, we don't allow that. Okay, so we just allow financial calculators into your uh, exam hall, which also includes HP, any HP financial calculator, HP2B, HP1B, or whatever. Also includes Texas Instrument. Know that Texas Instrument also. How many percent? That one you have to ask the administration on how your assessment is going to be done. Because what I need to deliver is first module 1, module 2, and module 3. All the examination and administration, you have to ask the secretariat. They will explain to you in detail because I do not know when, how, and what are the assessment requirement that is required by MFPC. Okay. Also, what we need to self-study module. Oh, okay. Whatever that I have given you in the notes and whatever that I run through is all the highlighted topics that I think would be very important for you. Okay. But you must understand that all mine are summary of the textbook is one thing. And second thing, all the modules that I went through, there is a detailed module to it. If you're talking about insurance planning, there is a detailed insurance module. If you're talking about investment, there's a detailed investment module. If you talk about tax planning and zakat planning, there is a detailed module, the whole topic just on that. So mine serves as a very fundamental introduction for you to understand when you go into all the modules. Then you'll be able to understand, yeah, we'll talk about this. Oh, now I'm learning in detail what is it. So all the exam questions actually come from the individual modules itself and not from M1. Okay, M1 is like an introduction for you to understand so that when you go, I believe some of you may not be even from a financial background. I used to have cabin crews, I used to have engineers, I used to have architects who have no financial planning background before. So when they came in, when they do module 1, it's a very good introduction for them so that when they go into the actual module, the actual topic, you already sort of like know that, oh, this is what the lecturer is talking about. Or because I heard it before. Yeah. So these are the things that, so now we are going into detail. Okay, so module 1 per se is not exactly how many or what are the topics or whatever. It won't come out in the exam because whatever that is going to come out from your final assessment is all from the other modules that I am introducing you into. Okay, that's first thing. Second thing, your final paper, which is your project paper, if you need to sit for that, is a combination of all the modules that you have learned here. Meaning you have to help your client plan insurance, investment, education, retirement, tax, okay, estate. All the modules is a combination of all that. TVOM table, no, you have to rely solely on your memory plus your memory of the calculator. That means you need to be very good in using a calculator in your calculations if there is a calculation. How many percent in exam for calculation? I can tell you is at least 20 or if you calculate insurance got calculation, investment got calculation, retirement planning got calculation, tax got calculation. So if each one only 2 questions already 10, right? So something like that. So I do not know what is the exact figure. but there is definitely. Okay, TM time value of money table that's not given because you have the calculator will help you. Answer that. What is the specific topic? Yes, basically it's all gearing you towards understanding the rest of the modules. When will exam be held? Please do ask the secretariat. I'm not too sure. Do we have answer to evaluation module today? Your evaluation module, the assessment test at the end of the page. Oh, evaluation. Do you have an evaluation module? I'm not too sure whether you have an evaluation module. Are you referring to the notes in the e-learning, the assessment, self-assessment test? Yes, sir. Self-assessment test. The end of the self-assessment test, there's already answers. It's ABC, right? Yeah. The answers are already there. Okay. When will the project paper? Oh, the project paper assignment is when you finish up to the sixth day, I think. The last lecturer will brief you. Okay. Sorry, Dr. Loga, you said that I am not sure. What is that you're referring to?
Good evening, Mr. Tay.
Yes, can you speak a
The
bit louder?
e-learning
Sorry,
portal.
I can't hear you. Yes, sorry.
Yeah, in the e-learning portal, we have evaluation module 1, fundamental of financial planning, at the
Okay.
end of the page. So do we have to answer it today, or is it a questions?
That one you really have to ask our, sorry, Secretary, what is that? Could you brief them on what is actually the concept of that? I think the evaluation model was more for the MPPP, right? That one that is per module assessment. I don't think, I'm not too sure whether your site, I think the evaluation that you're talking about is not a question. The evaluation is your evaluation of me and what you have learned from here. It's like a evaluation, right? I think that's the one. If that is the one that you're referring to, yes, you need to complete that. If not, they wouldn't take your attendance, I think. That is one of the requirements. That is the evaluation that you're talking about. The assessment test is a self-administered assessment test. That one is for you to sort of like revise what you did. Okay, I think that was the one that you are referring to, right? The evaluation module one. Okay. Yeah, Dr. Abdullah, sorry. Did I answer your question? Yeah, evaluation about the course.
Yeah, Mr. Tay. So that means we have to answer it today, right?
Yes. Yeah, the evaluation. It's not an answer. It's not a test. Oh, I thought it was a test. I'm sorry. No, it's not a test. It's just to grade me. Okay. And what else we improve on an online? I know it's very difficult. I'm so sorry that we have to go through an online. If not, we will have a physical class. It will be much more fun in a physical class where we can interact. But as far as we are concerned, because of the RMC, also we have to do this. I hope that I'm able to deliver all that you need to know about the next few modules that you're going to go into. I will still be here tomorrow as well as for module 3. So if there's any other questions, you are free to ask me, basically, right? Okay. Yeah, so go ahead to do your e-evaluation form and I'll see everyone tomorrow again at 10 o'clock, okay? But before you leave, I think you need to submit that evaluation form. Also, because the textbook has 13 chapters, yes, you may revisit my presentation slides, but it is not good enough. Like I said, I am the summary of the presentation slide, and the presentation slide is the summary of the textbook. So definitely, by the time you listen to me, right, you only get about 20% of what is actually in the textbook. I am not able to cover 100% of the textbook because of time, because of the current situation, and also you need to actually understand yourself because it's very difficult to gauge who will understand which. But having said that, every module would have a particular topic of interest that you need to concentrate on. Because at the end of the day, most importantly is you are able to create a comprehensive financial plan for your life. This is what the whole RFP is all about. for you to be able to assist your client to build up and create that financial plan moving forward. So whatever that you have learned today and all the other days from today is at the end of the day prepare you to have that working knowledge, to have that skill, to be able to, when you meet a client, okay, I'm able to analyze what you have, what you don't have, how am I going to help you, and these are the recommendations, and with a proper format, so that your clients will be able to do it. And this financial plan, if you pass it to me, you pass it to any of the financial planners, they are able to understand and they know what they're doing. So that is that kind of professional standard that we're trying to establish here. Okay, so yeah, it's very wide. Our financial topic is very wide. So not only from the textbook, you may also Google some of the things. And I strongly encourage you to find out what is happening to the financial world, to the political world, to the general business world, so that if your client asks you, at least you understand. And based on the knowledge that you gain, based on all the analytical skills and the theoretical things that we talked about, you are able to analyze and answer accordingly. All right, so that is what the value that we want to pass on to. Okay, all right. Any other questions? Okay, so back to you, Wawa, and or perhaps the any questions to the administration? You can ask the host. No questions. We are all good today.
Mr. Teh, sorry for interrupting again. There is a ranking 1 to 5. So 1 means good or bad, or 5 is good.
I think there's an instruction on top. I believe that 5 is good. So thank you very much, Dr. Lega, for your 5. If it is good, I think it is 1 to 5. Okay, correct me if I'm wrong. Please, anyone. If not, I will get very badly rated because everybody thinks that good is bad and bad is good. Anyone else having problem with your technical evaluation? Please do type in. Hopefully the administration will be able to assist you. If you have any other questions about the test, the finals, all that, all would be discussed about by the administration. But that is our model. That is our model for RFP. If you are on the capstone, if you want to have a full RFP destination, definitely you have to hand in a final year project to us, which is a financial plan for your clients. The link that I've sent in earlier, the advertisement that I did, is actually a one-day class. If I'm not mistaken, I'll be taking it. It's to guide those who are going to write a final year report on how it's best to approach that kind of financial report. Okay, so if you scroll back again, that would be concept. Yes, I think you can still do it within 2 hours, if I'm not mistaken. Yes, doctor, I hope I've answered your question earlier. You talk about what is restricted dealing, right? Basically, it's about we have limits on what type of securities that each license hold. That means depending on the qualification of the person in charge of compliance, depending on the person in charge of the dealings, operations, they can only deal in certain securities and not all securities. So that's why it's called restricted. I think restricted is not a good word. Probably we should use the word limited. Okay, because you are not, it's not a blanket license per se when you deal with securities under the CMSL. Because for us, it's not an issue because we are financial planners are having the financial planning category of the CMSL. Meaning, if you have that, our role is to do financial planning advisory only. We don't trade per se into the stock market on behalf of the client. We can only advise them on what to do. We can only give investment advice and financial advice. So that is our role in the financial planning category of the ECMSL. Okay. Yeah, that's the link that goes into e-learning. Okay, goodbye everyone. Hope to see you all tomorrow morning at 10. We will run through risk management. Thank you so much for your attention.
Thank you, sir.
Okay, sure. Right. Bye. But evaluation form. Thank you. Bye-bye. See you.